There are lots of cross currents. This isn't just about software. This isn't just about AI.
Everybody says there's insatiable demand for AI. I'm not sure we're quite seeing that yet.
There is a lot of companies that are going to benefit significantly from the AI build.
It does feel, though, that we're starting to approach maybe the end of that sell-off.
This is such a generational transformation. We're going to live in this bumpy ride.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday with a big week on deck. Economists anticipating payrolls Wednesday ahead of CPI Friday. As Takeichi is winning big in Japan and unleashing a rally in Japanese equities, China is fueling some selling in treasuries, urging banks to curb U.S. exposure, citing concerns over concentration risk.
Look, this fits a really nice narrative of Sell America and what happens if China liquidates its entire treasury holdings. It doesn't really do much for me on the market side. Maybe, yes, you are going to see a couple of basis points higher on long-term yields. But the reality is China has a combined $683 billion of U.S. Treasuries, 77% of foreign holdings, and just 2% of total securities outstanding. Half of that comes in the banks. And didn't U.S. regulators warn U.S. banks about concentration in long-term Treasuries right after the Silicon Valley collapse? So a real question here about what's fact in market terms and what's potentially narrative.
It's trimming is what it feels like rather than dumping, and some diversification. What is really going to matter this week, of course, given the fact that we had the longest government shutdown in history, is we're going to get clean data, finally. And it's a double whammy. We're going to get payrolls on Wednesday and then CPI on Friday. And what does this all mean for the Federal Reserve as they deal with two dual risks?
You want some optimism? Torsten Slok over at Apollo. Check this out. Software will not become a macro problem because the underlying economy is about to take off. He goes on to say, later this year, the conversation in markets will change from talking about Fed cuts to instead talking about the Fed having to hike.
You know, there were some interesting comments about that particular note yesterday out on social media saying, I want to take whatever he's taking. But at the same time, that is partly because nobody is expecting this to be part of the discussion, in part because of the Kevin Warsh Federal Reserve. If he is Fed chair, how likely is it he's going to be talking about some sort of rate hike in the face of pressure from President Trump? At the same time, should some of the projections come to pass with both the fiscal, the monetary boost, as well as the $4,000 trillion dollars of Capex, we could see some incredible growth.
Well, you led me there on fiscal. It is a midterm election year, which is why a lot of people think there's going to be more of a fiscal push in Washington. We should note there is potential for DHS to shut down on Friday. And that means Coast Guard, that means what's going on at the airport when you have your airport workers. That is something to keep in mind. But it is an election year, which means this administration wants to run it hot on monetary policy and on fiscal policy.
Japan might be running it hot too. Speaking of fiscal pushes, check out Japan. Japanese equities up overnight by 3.9%. A major election win over the weekend for Takeichi.
It was the biggest post-war really win for any single party going forward. She has more than a two-thirds majority. This is absolutely a clear mandate. Now the question is, what does she want to do with it? And this is increasingly going to be the focus. Jordan Rochester said, pointed to the fact that she held this election to try to get a mandate for her responsible and proactive fiscal policy. What is it? We aren't sure.
What does it actually look like in practice? Great note from Jordan a little bit earlier this morning. Framing really matters here. Fifth biggest economy on the planet, pushing for stimulus, boosting stocks, or fifth biggest economy on the planet, pushing for stimulus and being rejected by the bond market? Which one is it?
Yeah, you know, I'm not sure. And right now the market's not sure either. And that's the reason why you're not seeing a bigger sell-off in JGBs. It's a reason why the yen is actually strengthening. Right now, there is a real question about how much she can be successful in strengthening an economy that has been behind some of its potential for many years.
Lots to talk about this morning following a ton of volatility in the last week. Equity futures on the S&P down by 0.25%. Coming up this hour, Cameron Dawson of New Edge Wealth with stocks looking for some stability. Amy Gower of Morgan Stanley as gold swings back above 5K. And Dana Peterson of the Conference Board looking ahead to a key week of economic data. We begin this hour with stocks pulling back following the biggest one-day rally since May. Cameron Dawson of New Edge Wealth writing, for now, we see recent market volatility as a positioning and valuation recalibration, not a growth scare. Cameron joins us now for more. Cameron, good morning.
Good morning.
It did not feel like a positioning recalibration through much of last week. All that volatility, and we were down just 0.1%. on the S&P. What was last week?
Well, at the beginning of every bout of market volatility, we always ask ourselves, did anything happen that would cause EPS or GDP estimates to get revised lower? If the answer is no, it shortens shallow. If the answer is yes, it's typically deeper and more protracted. And so as we looked at the outlook over the course of last week, we thought that the answer to that growth question was no. And the way that we got to that is looking at something like high yield spreads not blowing out. High yield spreads are at 348 basis points. This is not a bond market that is freaking out about growth. You also look at market leadership. You've had really strong leadership out of industrials, energy, materials, financials, all areas of the market that would not be rallying if we were really concerned about growth. So the net of everything is that it seems to be more about positioning, valuation, and sentiment recalibration, not a deeper growth scare.
Well, let's stay on valuation. Could it have a dampening effect on valuations through the year ahead?
Yeah, I think that that is probably the biggest risk. If we all sit back and think about all of the justifications as to why the U.S. equity market should trade at 22 times forward or 38 times on the CAPE ratio, the argument went that because the components of the S&P 500 are that much more quality than they used to be, because of the higher weighting in tech, you have things like higher free cash flow margins, higher return on invested capital. But if we're starting to ding the outlook for free cash flow margins for the big hyperscalers, lower potentially return on invested capital for the software names, given AI uncertainty, it raises the question of, is that justification for ever higher valuations something that we should push back on?
Well, and this is the reason why, and we'll get to the fundamentals in just a minute. People are saying it feels more than just a violent shift in positioning that can really revert back. There has been a change in the way people view tech companies, how cash rich they are, how much they can keep giving dividends, and how much they can keep doing share buybacks, which have been a huge tailwind to this stock market. At what point do you see the technicals really turning against the U.S. equity market?
Yeah, I think it's first important to note that at the peak of the growth trade back in November of last year, you had max positioning in mega cap growth and max underweight positioning in cyclical. So there has been a big, huge positioning recalibration. I think your questions are really important because the whole notion is that these are very capital-light businesses that don't need a lot of incremental investment. And if you look at that over the past, what you saw is that all of these companies were able to grow earnings by double digits without having to spend any money. That was incredible. But now they're growing earnings by double digits, but they're having to spend hundreds of billions of dollars to do so.
Well, this raises the issue of the fundamentals, right? And we've seen this broadening out trade, and you think that it might have legs. We see the equal weight reaching all-time highs, even amid the carnage that we're seeing in the SaaScopocalypse. I think I said that correctly. Going forward, how much is that broadening out, and frankly, the entire index going higher, crimped by the story that's taking place with a fundamental shift in the way that tech companies are being valued and, frankly, are performing and existing in this world?
Yeah, I think it's such a fascinating point because if you think about the driver of all of this growth within tech spending, which is also leading into growth within value sectors, how much of this is dependent on some of these software names continuing to make investments that would be demand of AI? So I think some of this is all just a circular reference. If we start questioning the Capex growth going forward, does that also question some of these value rallies that we have seen lead the market since November?
You also talk about how these software companies are the ones that are going to be the ones to lead when it comes to AI, and they're the ones that have the most to gain. So would this be a moment to step in and get some of those stocks after the apocalypse?
Potentially the most to gain. They have the most to lose, but I think if applied properly, they actually have a lot to gain given the fact that they typically have high headcount. They typically have very strong customer relationships, but if they don't move quickly on AI, then they have a lot to lose. I think it's important with the software names to take a step back and think about the technicals because they are very, very oversold. If you look at them on a daily, they're oversold. On a weekly, they're oversold. If you look at them, they're now trading at the 200-week moving average. That was support back in 2025, back in 2022. So that would suggest that you have some kind of bounce. I think the big question is, can the software regain its leadership coming out of this bounce? I think that's a lot more in question just simply because there's all these doubts of things that effectively software companies can't disprove at this point because it's AI risks that could be out 1, 2, 3, 4 years in the future.
Look at where the leadership's coming from right now. Regional bank stocks up every single day through last week, on the week up by 7%. And it wasn't just the smaller names. Bank of America, Citi, JP Morgan up somewhere between 5 to 6% through last week. What do you think that speaks to?
Deregulation. I think it speaks to this question if banks would be allowed to grow their balance sheets further, if they're allowed to take on more leverage. I think it's fascinating that for the banks, they have been growing earnings over the course of the last 2 years at a faster pace than even prior to the great financial crisis, which just suggests that banks have been in an extraordinary period of operating leverage as they cut costs and still see really strong top-line growth. But it also, I think, is a reflection of this cyclical optimism, because just as you saw the regional banks rallying hard, you also saw things like transportation stocks rallying hard. And if you look at everything within the transportation side of things, you're seeing better shipping rates, you're seeing better rejection rates coming out of the truckers, you're seeing demand start to really cause a capacity tightening, which all suggests that there's cyclical underpinning of a little bit of a fire being lit in that part of the market. The question, of course, is can it continue?
Well, let's talk more about that at the index level. This is something Jim Reed of Deutsche Bank has raised. Many other people are pondering the same question at the moment. Can you have the kind of vicious rotation we're having over a prolonged period without index level stress?
If you think of times like 2022 or going back to 2000 to 2002, the answer would be no. If the largest weights in the market are continuing to come under significant pressure and really leading the market lower, then it's really hard for names that are a much smaller portion of the market to drag the overall index higher. So you could be in an environment where index level returns are kind of shoulder shrugging and ho-hum, but you have very strong returns in pockets of the market that are much smaller. And I think it's an important point as well that you're effectively moving liquidity out of very deep liquid parts of the market in tech and into much shallower, smaller parts of the market in these cyclicals, which can help explain some of the magnitude of these upside moves.
It was the story of the week. Will it be the story of the year? Cameron Dawson of New Edge Wealth is going to be sticking with us. Cameron gave a nod to this. It's from JP Morgan's Mark Murphy. It's difficult to prove a negative that AI won't disrupt software in a few years, which puts a cloud over some of those names, maybe for the time being.
Which raises this issue of even as we get earnings from a number of these SaaS companies, these software companies, how much will that matter if they come out with blowout earnings? We have people pointing to the fact that actually people's expectations for earnings have been increasing over time. It doesn't matter because you cannot prove that they won't be rendered obsolete in 3 minutes from Anthropic that then puts out an ad complaining about why they're useless.
And we're getting this for the next several months from Anthropic. This is the IPO roadshow. It started. This is it. And you're going to see it from other names in the mix as well.
And I have to say that their advertising was pretty much on fire. So clearly they are gaining steam on the social side of things with some pretty significant burns. But at the same time, this is the real question. What's the overhang for some of these business models?
There is a massive marketing effort underway and it's disrupting this equity market in a big way too. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Good morning, John. In Japan, Prime Minister Sanae Takaichi secured a historic election win, her Liberal Democratic Party winning a 2/3 supermajority in the lower house, which positions her as the nation's strongest leader in decades. In remarks, Takaichi vowed to build trust with financial markets amid concerns over how she'll pay for a planned tax cut. Meanwhile, here, Treasury Secretary Scott Bessent suggesting the Senate should begin its hearings on Kevin Warsh's Fed chair nomination. This despite GOP pushback to block the nomination until the criminal investigation against current Fed Chair Jay Powell is resolved. Bessent's pushing to get the hearings underway and, quote, see where the investigation goes. And in sports, the Seattle Seahawks are Super Bowl champions after a dominant performance over the New England Patriots. Seattle held New England scoreless until the fourth quarter, finishing the game with 6 sacks, 2 interceptions, and a fumble recovery. Running back Kenneth Walker was named MVP after rushing for 135 yards. It's the second title in Seattle franchise history. That's your Bloomberg Brief. John.
Yahara, thank you. I'm not even going to pretend. Forgive me, it's so un-American. But I go to bed so early. I didn't watch a single minute of this.
As an American,
none of it.
I can tell you that you probably didn't miss that much. Certainly the game itself was incredibly boring. And I can tell you, the Norwegian cross-country skier, the American, the figure skater. True. I'm telling you, the Olympics has some incredible
I'm so dedicated to the craft that I wake up to watch the Japanese close. That's what I'm in the business of doing.
Well, I don't think that you missed much last night, so congratulations.
Saw plenty in Japan. Up next on the program, a test for treasuries.
Thus far, the market has been very resilient. We've had some of our best auctions in a long time this year. We're seeing very good foreign demand.
Up next on the program, Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Stacked with economic data this week. Check out the calendar. Tomorrow we get retail sales, Wednesday payrolls, Thursday claims, Friday CPI. CPI on Friday. That's how things are shaping up. These are the scores going into all of that. Equity futures on the S&P 500 pulling back by just 0.25%. A volatile week last week. If you ask someone to guess what the index did, down 0.1% probably wouldn't have been the answer halfway through last week. Just amazing to see. On the Nasdaq, down about 0.5%. On the Russell, down 0.3%. Check out Japan. The Nikkei 225 closing at an all-time high. We rallied by 3.9% in the Japanese session. On dollar yen, down to 156.57. Yields just about unchanged at the long end of the curve. Takaichi getting a little bit of an endorsement from the market after a big election win over the weekend.
It seems like people are excited to see what she has to say and don't think that she'll be so extreme as to allow wild depreciation of the Japanese yen, or frankly, a Bank of Japan that does not hike rates in order to allow the economy to really gain steam. Just to highlight how big of a majority she got. She got 316 of the chamber's 465 seats. This for the Liberal Democratic Party. This is an absolutely astounding win that is the biggest going back to the 1940s.
Jane Foley was speaking earlier, talking about that she knows she has the bond market on her shoulders. And the fact of the matter is the election's over. She doesn't need to outdove the opposition, which were actually going to run an even looser fiscal policy than she wanted to. So that's why potentially the market is also taking her in stride.
A bit of yen strength this morning. Dollar yen down to 156.59. And the surveillance this morning, a test for treasuries.
We need to get back to something with a 3 in front of it in terms of deficit to GDP. That's why at FSOC, we are focused on growth as desirable, but also a lack of growth as a financial stability risk. Thus far, the market has been very resilient. We've had some of our best auctions in a long time this year. We're seeing very good foreign demand.
So here's the latest this morning. China pushing back on U.S. debt. Sources telling us here at Bloomberg that Chinese regulators are urging Chinese banks to pull back holdings of U.S. treasuries, citing concentration risk and volatility. With the latest, here's Bloomberg's Tyler Kendall. Morning, Tyler.
Hey, John. Good morning. Well, people familiar with the matter tell Bloomberg News that the guidance reflects a growing wariness among Chinese officials that large holdings of U.S. government debt could expose banks to sharp swings. Now, importantly, this does not extend to Chinese state holdings of U.S. treasuries, but comes amid what has been growing concerns from global investors about fiscal discipline here in Washington. The backdrop, of course, being what's been unpredictable policy making, the president's recent, perhaps more relaxed comments on weak dollar policy, and of course questions about the Fed's independence as we wait for Kevin Warsh to be confirmed. Plus, as you've already mentioned on the program, we've been watching closely the Japan Prime Minister Takaichi's election victory. She was endorsed by President Trump, and her coalition's now mandate and sweep in these elections will likely mean a bolstering in defense spending to combat China. Now, it's probably worth mentioning that U.S.-China relations have actually been relatively stable recently. In fact, the Treasury Secretary Scott Bessent went as far in an interview yesterday to applaud China for holding up their end of the U.S.-China trade truce that was struck late last year. Still, I will point out that our analysts at Bloomberg Economics say that this really does fit a longer-term strategic trajectory for Beijing, which has been limiting its exposure to U.S. dollar assets over the last decade. Now, John, worth mentioning, President Trump did have a phone call just last week with Chinese President Xi Jinping. Our reporting indicates that this guidance to Chinese banks came before that discussion between the two leaders happened.
Tyler Kendall with the latest down in Washington. Tyler, thank you. I think also worth mentioning that 10-year bond yields are only up by 2 or 3 basis points off the back of this story, higher to 4.23. Cameron Dawson of New Edge Wealth joins us now for more. Cameron, let's continue this conversation. The South America trade, are you actually seeing it in the data? Because we're seeing it in the headlines.
Yeah, definitely not. If you look at last year, we saw record numbers of inflows into treasuries as well as equities. So we ended 2025 with record foreign holdings in both treasuries and equities. You saw $500 billion worth of treasury increase in the overall holdings. So Sell America was definitely the narrative last year. It did not play out in practice. But it is good to remember that prices are set at the margin. And there's a great Bloomberg screen that's debt go. And what you can see is the treasury holdings of different countries countries. And for the last 13 years, China has effectively cut its treasury holdings in half. So this is not a new story. The question is, do you see less treasury buying from China? Do you also see less treasury buying potentially from Japan because home yields are higher, and potentially less treasury buying from Europe? You've seen a huge increase, a threefold increase in treasury holdings from the UK, for example. So could you see that at the margin start to come down and put pressure up on long-term yields?
Have we already seen that priced in? I mean, I'm asking this with respect to how much the Bank of Japan and, frankly, Takaichi is putting pressure on U.S. 10-year yields.
Yeah, I think you have potentially seen some of the fiscal worries get priced in early on within Japan, because you're seeing the response this morning is not nearly as violent. The sell-off in bonds is not nearly as violent as what we're seeing as the rise in equities. I do still think that there's a very little direction within the 10-year Treasury. It's at 4.2%. All of its moving averages are just kind of coalesced in one tight area, which says that there's really no conviction within the 10-year Treasury yield. If the 10-year Treasury believed the equity market and the cyclical rebound, I don't think that we would be seeing 10 years at 4.2%. They'd likely be closer to 4.6%.
Which is the reason why people are looking at Kevin Warsh, the new, potentially new incoming Fed chair, should he get confirmed or even heard. Secretary Bessent had some really interesting things to say over the weekend about how it was probably going to take about a year or more in order to really start to wind down the balance sheet in any significant way. And he made some other comments at a time when we're looking at something of a Fed Treasury Accord or something like that. Do you have a sense of what that could look like?
Yeah, well, we've been joking that they should rebrand quantitative easing as quantitative freedom in order to be able to navigate this balance sheet runoff. I think it's a really big question because we know that Treasury wants yields to move lower, not just on the front end in order to reduce Treasury borrowing costs, which interest expense is over $1 trillion. It's larger than defense spending. So this is something that they want the front end to come down, but they also want the back end to come down. They want to have relief within the housing market with mortgage rates coming lower, cyclical areas of the market getting stimulated by lower long-term yields. It's really hard to do that in a very pro-growth, pro-stimulus kind of backdrop, which means that it suggests in order to accomplish 3% growth and 3% Treasury yields, you need some kind of Treasury market intervention. It can't do it alone.
So what would that look like? And I'm glad you bring this up because just a few hours ago, the president actually put on Truth Social a Bloomberg story talking about a Barclays note about how this president wants to see mortgage rates drop to 5% this year. Can they actually get to that?
Well, some of the things are within their control. We saw the mortgage buying that was pushed through back a couple of months ago. And then there's, of course, things that are out of their control. And the best way to think about the yield curve is that the shorter you are in the yield curve, the more it's controlled by the Fed. As you move longer and longer out, it's controlled by supply and demand. The supply side, of course, is what's going on within the fiscal side of things. And the demand side is demand from not just domestic owners, but foreign owners. And I think that that's one of the big questions that everybody's wrestling with this morning.
Final word on Torsten Slok of Apollo. You saw the quote. I'm sure you read it over the weekend. Rate hikes at the end of the year. You think that's the conversation?
Well, if you look at the warp screen, they actually have a slight probability of rate hikes starting in 2027. I don't think that this is something that Warsh will necessarily want to push through, but it is a committee vote. And think of us going forward in just June. If we have this kind of strong economy where we see some reacceleration, are we in an environment where the chair could be the only one voting for rate cuts? What a wild world.
Cameron Dawson of New Edge Wealth. Cameron, it's good to see you. Just imagine that 6 months out.
Yeah, I'm just trying to imagine the truth postings, or maybe this comes right after the election. Should there be a change in leadership, maybe it won't be a problem to raise rates. But I'm curious going forward about what kind of pushback we get from the president. And frankly, to Cameron's point, what kind of consensus do you get on a committee that has been really named by the Fed chair in each consecutive era? And is it going to be the same? Is it going to be the Warsh Fed, or is it going to be the Warsh, Waller, etc.?
I don't think a rate hike conversation is going to go down too well at the confirmation hearing when we eventually get a confirmation hearing. Coming up on the programme, Amy Gower of Morgan Stanley on the swings, the wild swings in precious metals. Plus, Yahira has your morning movers. Novo shares surging as Hims and Hers abandons a copycat weight loss pill. We've got Novo up by close to 7%. Max Kenner of HSBC calling it rotational pain, and it was painful for a lot of you, I know, over the last week. Yet still, We closed out last week within 1% of all-time highs and down on the week just 0.1% on the S&P 500 futures. Down another 0.2% on the S&P. On the Nasdaq, down by 0.4. It was on the Nasdaq, the big tech players, where we saw a lot of that volatility. The Nasdaq having its worst week of the year so far. But elsewhere, the equal weight S&P 500, the Russell 2000 posting a gain of 2% on the week. And at the moment, we pull back from those record highs. On the Russell 2000, we're down by about 0.2%. Switch to the board and get to the bond market. There is a tug of war. How much weight do you put on the ISMs versus the labour market data of the last week? Because those two data points tell a very different story. ISMs are telling you that things are fine and they're going to pick up, particularly ISM manufacturing. Elsewhere, the labour market data, dreadful. Will that be validated by payrolls this Wednesday?
Yeah, payrolls, and then, of course, we get a CPI. And it's really good that you pointed to the ISM because we have someone coming on later, Jill Carey Hall of Bank of America, who thinks that ISM actually leads this rotational trade that the likes of Max Kettner is talking about, that is part of the whole rejuvenation of the U.S. economy story. At the same time, is this still the jobless recovery, right? Can you still have that optimism if you don't have the hiring to accompany it?
Remember all those headlines? Sell the US dollar debasement, all of that stuff, and then risk appetite gets a bit of a punch in the face, and what happens? The dollar rallies, one of the best weeks we've had this year. The dollar index, the best week since the first full week of January. Euro dollar this morning up to about 118.65, but you really do start to understand the correlation or lack thereof between risk appetite and the US dollar. And when risk appetite unwound, the bid came back into the US dollar.
Yeah, and arguably, and some people might say that the strength that you saw in the US dollar that really stemmed from Kevin Warsh getting the nod to be the next Fed chair was part of what unwound the entire market. There's an entire theory about how the sort of sell America trade was so embedded in conviction trades that alone getting sort of questioned really unraveled a lot of what was out there.
The dollar index a little bit softer this morning. We're down about 1/3%. As we count you down to the opening bell, 3 hours away, let's get you some morning movers with Yahira. Hey, Yahira.
Hi, John. It looks like the drama between Novo and Hims may finally be over, at least for now. We are seeing Novo shares rising 6.6% in the pre-market after Hims and Hers backed away from its plans to sell a copycat version of its Wegovy pill. This comes after the FDA said it would crack down on knockoff weight loss pills. It was a much-needed reprieve for Novo, which has had a rough week. Hims and Hers having a rough morning so far. It is plunging down more than 15%. Meanwhile, we move on to Once Upon a Farm. This is actually a company by Jennifer Garner's organic snack food company. They sell things like fruit pouches for kids and babies. It had a stellar debut on Friday, rising nearly 17%, up another 9% this morning. It's a welcome sign for the IPO market, as analysts say broadly that we will see a pickup in listings this year. And we end on the supermarket chain Kroger. Shares are rising 5.25% on our reporting that it's set to announce it has plans to name a former Walmart executive as its next CEO. Our sources say Greg Foran, who used to run Walmart US, is set to take the top job, and it would mark the first time that Kroger appoints an outsider to run the company. John?
Yahira, thanks for the update. More from Yahira a little bit later this hour. On a raise out this morning, Chinese regulators urging the nation's top banks to scale back holdings of U.S. government debt. Sources telling us here at Bloomberg the move is framed around diversifying market risk. Elsewhere, Japanese Prime Minister Sanae Takaichi is securing a historic election win, positioning herself as Japan's strongest leader in decades. Her ruling Liberal Democratic Party achieving the largest post-war victory for a single party in a general election. And finally, the Treasury Secretary Scott Bessent turning up the heat on the Senate.
And Senator Tillis has come out and said he thinks that Kevin Warsh is a very strong candidate. So I would say, why don't we get the hearings underway and see where Jeanine Pirro's investigation goes.
The Treasury Secretary adding Kevin Warsh's nomination for Fed chair should proceed despite a blockade attempt from his own party.
Let's see whether that gains any steam. He also really backed away from saying the Department of Justice was going to drop the case, which is what a lot of people are pushing for in order to get this underway. There does seem to be an eagerness, though, to get the new Fed chair in place. Some people are wondering if the Department of Justice inquiry does not get resolved, how long does this go on, and does Chair Powell become the Fed chair for the remainder of 2026?
Well, Senator Tillis told us he'll go on and basically for another 300 plus days until he retires. But the Treasury Secretary clearly wants to get the show on the road road. And what he was pointing to there was a parallel track. He can't come out and say the DOJ is going to drop it, especially since the president just last week said, we have to investigate, see to the end. The issue is what is going on right now with the investigation. We really haven't gotten an update. And there are reports that the Fed hasn't complied with the probe. So potentially that is going to be a drag. At the same time, Scott Bessent is just saying, at least at the minimum, start the hearings.
Really reading the tea leaves here, so forgive me, but I think that was the first acknowledgement that this might become a problem down in Washington, D.C., because the Treasury Secretary is offering an alternative.
Yeah,
because there is an understanding here that this is going to take some time.
That alternative, though, isn't going to be taken. So I wonder
Absolutely
what kind of
not.
back channels are going to be explored in order to get the Department of Justice to drop the case. But it's clearly on his mind, and I think that you're right to say that. Also interesting, though, he started to talk about the Kevin Warsh Fed and what that looks like, raising a question, and Krishna Guha raised this issue. Does he have veto power over things? How much control will he have over Fed policy wearing his Treasury hat?
Might be comfortable with the timeline now, but the closer we get to May and June, I think that conversation is going to take on some additional urgency if we haven't addressed things. Let's turn to the metals market. Some major moves in the last week in both gold and in silver. The Treasury Secretary, Scott Bessent, also pointing the finger over the wild swings in precious metals.
The gold move, things have gotten a little unruly in China. They're having to tighten margin requirements. So the gold looks to me kind of like a classical speculative blow-off.
Gold hovering around 5K after a stretch of historic volatility. Amy Garrett of Morgan Stanley seeing more upside ahead with a bull case of 5,700 for the second half of the year. Amy joins us now for more. Amy, good to see you. Welcome to New York.
Great to be here.
Wild swings, not just in gold, but silver too. And if we can bring up the silver chart year to date, the silver chart is one of the most ridiculous things I've ever seen covering financial markets. A rally of 60% and then a complete round trip. On what?
Yeah, look, I think with silver, you do always expect more volatility. It has generally lower liquidity. There's smaller trading volumes going through. I think we could say, look, the setup was reasonably supportive in terms of we'd eroded a lot of the inventory. And so when somebody needs metal immediately and that metal is not available, it sort of goes to the highest bidder and the price can accelerate very rapidly. And clearly there was an element of momentum here as well. And then, of course, when we had that turnaround in both gold and silver with potentially the nomination of Warsh coming through and some of that momentum coming off, it's not surprising we pulled back a long way. I think what we've been struggling with is what is the right valuation for silver here? And especially when you see, a $50 trading range for something that only started the year at $75, that's quite difficult to do.
The Treasury Secretary was pointing the finger at China with regards to gold. He said things were getting a little unruly in China. Can you translate? What does he mean by that?
So I think definitely there's been an element of momentum and high volumes going through, and we've seen this across the metals, very, very high trading volumes in China. And so we've seen some sort of controls from the exchanges and position limits trying to curb things back into place. We might also be seeing a bit of positioning taken off ahead of Lunar New Year because things will generally be slowing down there. So I think partly that's probably been having a hand here, but I think also unsurprising when you get sort of a straight line up in metals to have a bit of consolidation, take a pause. That's not unusual.
So it seemed like Scott Bessent was talking about the hat. He's currently blaming this one trader who had an incredible slew of losses in China and then fled the country. I mean, it just raises the question of how financialized some of these metals markets have gotten. The idea that suddenly people are turning to precious metals as an alternative to things like treasuries, which are a very deep liquid market. How comfortable is the gold market, is the silver market with this moniker of an alternative, to be treated as an alternative to full faith and credit in the United States government?
So I think gold has kind of always had this role as a safe haven traditionally. So you have had, yes, financial flows, but also real physical buying from central banks, from ETFs, and kind of we're used to this sort of flow in gold. I think for silver, because it's also got that industrial metal hat, probably this is where it's a little more difficult because there are real end users who also need silver. So when people are suddenly trying to buy quite large volumes for financial reasons, and then you still have the physical buyers, that's where things get a little tense. So gold, I would say, should be okay with this. Silver, obviously a lot of volatility as we're seeing.
Then you overlay the fundamentals, which is that every country in the world is trying to build up its strategic reserves of some metals, as well as try to build out their infrastructure. We heard about the vault from President Trump, that he wants to stockpile certain metals. Do you have a sense of how much that could really skew valuations? Is that already priced in?
Yeah, so I think the stockpiling theme is super interesting. So we have, as you say, Project Vault launched in the US, which is looking for any critical minerals. Now, the US critical minerals list is about 60 different metals. Some of these are very, very small markets. Some of these are much bigger. And so I think we need to see what ultimately is going to be top priority in terms of stockpiling. I can think, it's probably, it could be any of those metals, but the larger ones could be more easily able to absorb that stockpiling. You could say for copper, actually, already, the US has already built quite a large stockpile. Last year, the US imported probably 2/3 again what it would normally need, and most of that is just sat in the warehouse system. So actually, you could say the US may have an incentive to try and keep that in the country rather than letting that be exported.
I was going to ask you about copper, too, because really this matters with demand in China. How weak is the demand, is soft the demand right now for copper in China?
Yeah, I think it's remarkable how strong copper has been considering what we're seeing in the Chinese demand. And this is not a new story. This is something that started back in September, October time. Q4, we saw Chinese apparent consumption down around 12% year on year. So that really weighing on the sort of total full year 2025 demand number. We're going into Lunar New Year, which is where activity typically slows down. So often you see the semi-fabricators slowing down their activity. But yet copper has proved remarkably resilient, which I think tells you there's broader macro factors at play. There's this theme around the AI trade, stockpiling, scarcity, supply chains, and then also these macro overlays of rate cuts still coming through, demand for real assets from investors.
Lisa mentioned Project Vault. What about the fact this administration also has tariffs on some of these metals?
Yeah, so at the moment you've got your steel and aluminium tariffs in place, and what it looks like, if anything, is actually the US has been importing less aluminium than it needs at the moment. So that would imply actually destocking rather than stocking. And copper, we only have tariffs on things like copper wire, not on copper itself, but we are due to hear whether those might come in for 2027.
Do you think they're going to do it?
It's a tricky one to call. I'd say the US is probably more reliant on imports of aluminium than copper. So arguably, if they can do it on aluminium, they could do it on copper. The market is not really pricing that is going to happen at the moment. There's very little premium for US metal at this point. But the other thing they could do is, of course, just kick the can down the road and say, look, let's see again in 6 months from now. And that is more likely to keep the metal on shore, but without really having too much impact on domestic US copper prices.
And just how tight is the copper market at the moment?
So we do have a lot of inventory. We've had this big inventory build in the US, but I would almost disregard that for now because it's sort of locked in the US. If you think of that as a strategic reserve, then you'd say the copper market's pretty tight. London inventory is low. Chinese inventory, yes, is building, which we think is this demand weakness. But we always get builds around this time of year. To me, the big signal for us is going to be as we come out of Lunar New Year, what happens in China? Does activity pick up or not? And that's going to really tell us, is China just pausing because prices have moved a lot? Or is this China actually stepping away from the market? Normally, they pause, they kind of get used to the new price levels, and then they come back in.
Can we finish on supply? Back in the day, give a miner $1, they'll dig a hole. Are they still digging holes?
Not so much. So we are now 10 years on from the 2015-16 metals price downturn, which is where mining companies largely cut their budgets. And we're really starting to feel the effects of that. And the challenge is this long lead time. So we can't give you like a big list of new mines that are coming on in the next few years. And even now where copper prices are really high, you'd argue probably most copper projects in the world would make sense here. We're still seeing companies trying to buy each other or buy assets rather than building from scratch. So really what we're then hoping for is a bit of scrap, a bit of brownfield expansion, but nothing major.
Amy, appreciate your time. It's good to see you in person as well. Amy Gabber there of Morgan Stanley. Back in the day, that was the story. They've become very disciplined since then, scarred by the events of 10 years or so ago.
Yeah, and how much prices went down and how much they've had a difficulty in actually getting projects through. I mean, I'm surprised that we got through that whole conversation without talking about Resolution mines down in the southwest of the United States. I mean, they're still kind of looking for those copper reserves that they know are there, but they just can't extract out of the ground.
We'll find time to talk about Resolution copper another time. Don't worry, Amy. We'll make that happen. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Apollo Global Management has set a new lending record. The firm originated $97 billion in the fourth quarter, pushing the total to $309 billion for the year. But Apollo remains delayed in returning capital to investors in its private equity and hybrid funds, blaming the dynamic exit environment. Meanwhile, hedge funds are betting on more pound weakness as UK Prime Minister Keir Starmer's future hangs in the balance. The PM's chief of staff resigned yesterday amid backlash over his appointments of Peter Mandelson as ambassador to the U.S., despite his ties to Jeffrey Epstein. Starmer is expected to either try to shore up his position or potentially be forced out. And Bad Bunny making history at the Super Bowl, the Grammy-winning artist becoming the first to perform on the big stage entirely in Spanish. The 14-minute set included guest performances by Lady Gaga and Ricky Martin. President Trump weighing in on the performance, calling it one of the worst ever and criticizing the dancing. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Appreciate it. Up next on the program, the Fed's tug of war.
The labor market looks weaker, right? In this whole kind of battle that the Fed is fighting, this tug of war between inflation and labor, it feels like the labor market will win out.
Up next on the program, Dana Peterson at the Conference Board, live from New York City. You're watching Bloomberg TV. Closed out last week with the best day since May. Closed out last week for a weekly decline of just 0.1%, even as software stocks finished the week down by about 8%. Equity futures this morning up by 0.25% on the S&P, on the Nasdaq 100 down by 0.4%, on the Russell 2000 negative by 0.3%. We're down to start the week, down across the board. Under surveillance this morning, the Fed's tug of war.
Certainly, the last handful of data points look like a kind of a re-acceleration to the downside. The labor market looks weaker, right? In this whole kind of battle that the Fed is fighting, this tug of war between inflation and labor, it feels like the labor market will win out. You need a lot more data to really determine a trend.
So here's the latest this morning. The Federal Reserve awaiting delayed reports on both employment and inflation. U.S. payrolls due on Wednesday, followed by CPI on Friday. Dana Peterson of the Conference Board writing, the next 5 days will be a blockbuster week. To look ahead to that, Dana joins us now for more. Dana, good morning. Let's talk about confidence first. The CEOs that we speak to sound confident. Are the CEOs you hear from bullish about hiring? Because that seems to be the story in the data at the moment.
Not really. They're still waiting on the sidelines, and we're seeing that in the actual data. Payrolls have been pretty small, but that's also consistent with a labor market that's still healthy, very close to maximum employment.
Is it a supply side factor then, if it's a labor market that's still healthy? Because at the moment, we're looking back 12 months and we could see jobs growth at zero. Nothing, Dana. That doesn't sound healthy.
Well, it's about levels, not the deltas, right? So, if you look at the data, either the establishment payrolls or the household survey in levels, most people are still working. And those levels have returned to the path that we had before the pandemic with a delta. And that delta is really the advancement of people retiring. Other than that, most people are still working if they want to.
Dana, in the Conference Board's own survey, a number of respondents, the greatest number of respondents going back to 2021, say that jobs are hard to get. You see an increasing amount of concern about the availability of work. And I'm just wondering how much of a forward-leading indicator this tends to be in prior readings.
Well, I think this time it's a little bit different. Yes, it is pointing to the fact that the unemployment rate could rise because some people, especially in industries like finance and tech, are being let go, and it's very difficult for them to find new jobs. And so that's accurate. The survey is saying, yeah, it's tough to get a job out there if you don't already have one. But when you look at the JOLTS data and even the unemployment rate, most companies are not letting anyone go. So we're kind of still in this low hire, low fire place. And again, it's about the level. The number of people who are actually working is very high.
That said, Dana, we have seen jobless claims start to tick up. And there is some concern that this particular reading that we get on Wednesday of non-farm payrolls is going to be really skewed to the downside from the revisions, the benchmark revisions that are going to come out. I'm just wondering what you're looking for to determine whether you're starting to see a shift from low hire, low fire dynamic to something slightly different, a little bit more pernicious, a little bit more protracted to the downside.
Sure. So I'll be looking at two things. Yes, you can look at payrolls in terms of the change. But again, when you're close to full employment, you don't need much change at all because most people are working. So I would look at the level of that. And certainly with the unemployment rate, I would dig beneath the surface and take a look at who's driving it. Is it people who are newly let go? Or is it people who are still, looking for jobs? You have to look at those details to understand what's going on in the labor market.
And then, of course, Friday, we're going to get CPI. So as you say, blockbuster week for economic data. What are you focused on when it comes to the inflation report?
Absolutely. I'm looking at, again, underneath the surface, first looking at goods, especially those that are most likely to be imported. Are we still seeing prices increase for those items? And we've seen that in the data over the last few months. So the tariff effect is coming in. However, it's being offset mightily by slowing shelter costs, and that's a good thing. So I'll be looking at the shelter costs to make sure that's still putting downward pressure on overall inflation. But I'll also be looking at any services that are indirectly affected by tariffs, and also things like health insurance and car insurance, which we know have been rising.
When it comes to when you said earlier about CEOs, they're waiting on the sidelines. What exactly do CEOs want to hear in order for them to get back in and start hiring again?
Well, I think for a lot of them, any of them that are exposed in some form or fashion to supply chains are waiting for the trade deals to be completed. There's still some major trade deals that have not been affected. And also, USMCA renegotiations start this summer. And if you are an auto company or a lumber company, you're curious to know whether or not you're going to have to pay different rates of tariffs, whether a product is moving from Canada to the U.S. or from Mexico to the U.S. And so I think they really want to know what that looks like for them.
Dana, it's good to hear from you. Thanks for breaking things down. Dana Peterson there at the conference board. I think it's fair to say that Dana poured a bit of freezing cold water over their own survey with some of that analysis.
You see that this time might be somewhat different in terms of just how much it leads to the potential weakening in the labor market. The fact that a forward-leading indicator that in the past might have been somewhat predictive now is being sort of cast with some doubt from the person who's actually crafting that survey raises questions about how you get a clear signal about this labor market. I mean, this is something that we talk about a lot, especially at a time that does feel like an inflection on multiple levels.
I also feel like this was what we heard at Davos. There's a diversification where what corporate America feels and what the everyday consumer feels. They're amped up while everyday consumers are still worried about beef prices.
Big range of estimates going into Wednesday. The median estimate in our survey is around 70k. The high is 135, the low is -10. And if you ask the people at either end of the extreme, the 135 and the -10, both those individuals, Citi, Standard Chartered, are concerned about the labour market data.
Yeah, I was going to say, show me the number, but give me the interpretation, because right now people could get a number and it could be bad, even if it's 100,000 new jobs that are created, or it could be good if it's a negative. I mean, there are some questions here about whether we're seeing a secular or cyclical shift. You've talked about this many times. And ultimately, we're still not getting clarity, even as peripheral data does seem to suggest that there's some deterioration in the labor market.
Exhausted after last week, even with the weekend.
I mean, no, I'm ready to go. I'm so excited for this week. I think it's great.
Absolutely nuts, the year so far. Just ridiculous. In the next hour of Bloomberg Surveillance, we'll catch up with Bob Elliott of Unlimited Funds, Henrietta Trey's of Veda Partners, the former Fed Vice Chair Richard Clarida, and John Belton of Gabelli Funds. The second hour of Bloomberg Surveillance, just around the corner.
We think that there's a potential for upside to global economic growth.
We've been on a gradual slowdown for months now.
The momentum seems to be improving. If the labor market's turning, it tends to trend.
The real economic story continues.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Following a massive week last week, A week filled with volatility. 4 percentage points of outperformance on the Russell versus the Nasdaq. That is quite a week. Equity futures this morning negative by 0.25%. On the Nasdaq 100, we're down by 0.5. On the Russell, we're down by 0.3. The week ahead looks like this. Tons of economic data, including payrolls on Wednesday and CPI this coming Friday.
I am excited for this week. We're going to get data. We're going to get earnings. We're going to get stuff that actually is going to give us a picture of what the fundamental backdrop looks like. And this is all the more important after the SaaScopocalypse of 2026, because there is this ultimate question. And you pointed to Jim Reed's note of Deutsche Bank, where he's saying this is what happened in 2000. For 6 months, the rotation trade was there and it was creating a ballast under the carnage that we saw in the tech sector. But then it couldn't keep up. It couldn't really push back against the trend. Do we get the same thing if the U.S. economy doesn't have the same fervor that people like Torsten Slot think it does?
And this Wednesday's jobs report carries even more weight because every January it comes out with these job revisions that go through March of 2025. So we could get a downtrend in jobs. So that is why there's extra weight on this jobs report, and people are incredibly excited to see what happens from it. And at the same time, we're going to get CPI on Friday. Good Mary Daly over the weekend taking to Twitter saying it is important for Americans that the Fed make sure that we are on top of inflation, but at the same time, they're not losing their jobs.
I'm just excited to speak to our next guest. This quote: policy announcements, attacks on Powell and Fed share pick make it clear they plan to be debased AF. He needs to define what all that means in just a moment.
Yeah, say it out loud. Debased AF.
I literally wrote down a question. Please explain in your words what debased AF means.
We're giving him some time to come up with an answer now. Coming up on the programme, we'll catch up with Bob Elliott of Unlimited Funds as equities seek a rebound. Henrietta Trays of Vader Partners as Scott Besson urges the Senate to open Fed chair hearings. And Richard Clarida, the former Fed vice chair, with the central bank's balance sheet in focus. We begin this hour with stocks inching lower at the start of a busy week filled with economic data. Bob Elliott of Unlimited Funds seeing the case for US equities building, writing not only are earnings growing double digits against low expectations, but macro surprises are strong with little reaction from the equity market. Bob joins us now for more. Bob, good morning.
Good morning.
Time to answer then. OK, so here's the quote again. Policy announcements, attack on Powell and Fed chair pick make it clear they plan to be debased AF. What do you mean by that?
Well, I think there's a real question as we're coming into the year about whether the administration would pursue essentially a set of policies that would continue the debasement and easy money, easy street policies that they've sort of signaled and now sort of carried through in the first few weeks of the year. And, you know, the trade-off was whether they're going to do that or accept lower growth. And it's pretty clear they're going to do whatever it takes to juice the economy and markets. Now, there's always a question whether they'll succeed, but it's clear that they're going to choose a debasement path ahead. And it's a little play on based AF, which
of course,
which you know you can look up what the young kids are saying these days.
We'll let other people do that for us this morning. That's the move in precious metals at the start of the year. What do you think has led to the rewind of the move in precious metals since the start of the year?
Well, sometimes you get speculative manias, and I think if anything, the mania that you saw in gold, and then obviously extreme in silver, was really about showing how much liquidity there is out in the market. And so you saw incredible flows, like flows into silver that were the most extreme, you know, by 10x that they've ever been. That doesn't happen in an environment of tight money or of paring back risk taking. That happens in an environment where there's lots of liquidity and people are just looking for the next mania and the next mania. Now, I think it's easy to sort of bring silver and gold and hold them together as the same trade. One is totally speculative by people who are tourists in those markets. That's silver. The gold trade is, you know, got hot for a minute and then pared back. But if you look at the underlying fundamentals of what's going on there, whether it's ETF flows, which remain relatively subdued, the Chinese Shanghai premium, which has come down a lot, like the underlying fundamental dynamic in gold, the bullish dynamic in gold, is quite intact. And that's why what we've seen is pretty sustained buying pressure over the course of the last couple of days. And, you know, things like today's announcement that the Chinese banks are going to get out of U.S. bonds is just further evidence that, you know, the hard money world is going to benefit from the easy street policies of the U.S.
You're saying two things that are somewhat contradictory. On one hand, you're saying it's a mania into metals. On the other hand, you're saying on the margins with gold, as with other assets, it's what you think is going to dominate this year, which is the get out trade as foreign investors get out of U.S. assets. Where do you see evidence truly that the get out trade is taking place?
Well, I think you see it across a wide range of different trades. I mean, first of all, you're seeing foreign stock markets crush the U.S. over the course of, to start off the year. And so you see, and driven by fundamental pressure. So you see today's moves in Japan. That's such a good example where you have a policy environment and a political environment that's going to be favorable to Japanese stocks. Why wouldn't, and the world is underweight Japanese stocks. And massively overweight U.S. stocks. And so you're seeing folks move. A lot of the moves initially are around in the currency hedging, right? The first move that you can do, which is super easy, is to just hedge back your currency positions and move to local currency. Because basically everyone in the world, every major allocator in the world has had an implicit long dollar position over the course of the last 15 years. It's traded well, but it hasn't traded well over 10 years, 10, 15 years, but it hasn't traded well since. And so that's the first move. Cut back on your implicit dollar longs, and then scale back. Every incremental dollar going into a domestic, meaning like a European or Japanese market, and not in the U.S. market, favors those markets.
How much is this really being driven, though, by a concern about being debased AF? And how much is this actually driven by the fact that this is a bull market and there is growth in a lot of places? And frankly, there's a catch-up act being played in certain emerging markets, particularly with technology. I mean, how do you decipher which is which?
Well, I think in some cases, when you look at the developed markets and you look at the breakdown of why they've been able to outperform, it's a combination of currency and PEs expanding, right? So expectations are being, are picking up in those markets. If you look at something like emerging markets in aggregate, and of course there's a wide range there, that story is actually quite fundamental. And so you see basically earnings growth describing 100% of the strength in those equity markets. And so in many ways, emerging markets, which are long forgotten by the developed world or major allocator, that looks like the most attractive place to be, and we're starting to see capital flow into those positions.
Bob, when it comes to the Fed, does Kevin Warsh make sense if this administration wants to be debased AF?
Well, I think the end of Trump's Truth Social post about him was most telling. Not the one about the fact that he was good looking, but the part that he said that he can be
Thanks
relied on.
Thanks for clarifying. That he can be relied on.
That he can be relied on. And so, and even this sort of talk about the Treasury Fed coordination that has been highlighted over the last couple of days, the question is, what does that coordination look like? Back in the 50s, it was about independence. The question now is it about independence or it's about coordination to ensure low rates and cheap Treasury financing in the future? And so you have a highly political person. His language, his rhetoric has made it very clear he's favorable to administration policies and willing to be easy, even in the face of relatively strong conditions. And that's probably what we're going to see.
So you're not concerned that Kevin Warsh, or you don't think he's a hawk?
Well, I think he is a political figure, and he's demonstrated, and I think that's one of the challenges with him. I argued that maybe we should have somebody who has some economics or real markets experience running the Fed. Instead, we got a politically connected lawyer again. And so I think that the challenge is what we get here is we get someone who is tied to the administration, who's going to be doing the bidding. He's basically made that clear. His rhetoric has been very clear back through time in terms of his soft money rhetoric aligning very well with previous Republican administrations. And so I don't see why you would think that he would break out of that mold ahead. Until the next election. Is that what you're implying? If there's a change in 28? Well, I think it's pretty clear how he's behaved in the past. Actually, Anna Wong from the Bloomberg team has done a really good job highlighting how his language has changed in different periods depending upon who's in the office. And so I think it's one of the rare cases where we have years, decades of track record to see what his rhetoric is relative to what conditions are. And he's proved himself to be a political actor in making policy.
So let's talk about a hypothetical. Let's say Torsten Slok is right, and that later this year, the economy is running so hot that people start to think maybe a rate hike would be necessary. Kevin Warsh, you're saying, if he is a political actor, would not necessarily take action. What happens? How does this work if people are waiting until 2028 for that rate hike to happen? Right. So it's an environment, easy street monetary policy is an environment that's favorable to gold and stocks in that environment, and is challenging for bonds. And so what you'd see is you could easily see monetary policy on the short end that's too easy relative to conditions,
And the long end is going to punish the market related to that. So trades, even right now, when you look at what's going on with the yield curve is not that steep relative to the strength in the economy, relative to the upside surprises we've seen, relative to where we are in the cycle, and coming out of a significant easing already. And so I think trades that favor, easy street stocks versus bonds, gold, and short dollar positions are all going to win in that sort of environment.
210's at 73. How much steeper are you looking for that curve to get?
Well, remember, typically in growth rebounds coming out of easing environments, you see the curve steepen to hundreds of basis points. And so while we're squinting at whether it's at 73 and the nearby high and stuff like that, like from a macro perspective, the yield curve is very flat right now. And you have an administration that is very keen on delivering easy policy relative to conditions.
Just quickly, what do you think is going to drive foreign exchange, the front end or the longer end of the curve?
I think it's much more about how the foreign investors see the over easy monetary policy that's being delivered. And so it's all about that hedging on expectations that easy money is going to happen.
Bob, thoughtful stuff, lots to think about. A very provoking framework to think about the financial markets.
Yeah,
Although
interesting to me that the Sell America trade is not necessarily driven by antipathy toward of statements coming out of the White House, but rather having to do with easy money coming out of the Federal Reserve. This all comes down to how the Federal Reserve acts if there is a Torsten Slok-like scenario down the line, which is a reacceleration and a Federal Reserve that maybe ought to be, in the market's eyes, talking about a rate hike, but might politically be disincentivized to do so.
You'd have to think that Chair Walsh is going to let that rip if we do get that rapid acceleration into year end.
Which goes to the question of, is it going to be the Walsh Fed or is it going to be the everybody Fed? Chime in and let's see what we get.
Hey, Bob, thank you. Thanks for dropping by.
Yeah.
Bob Elliott of Unlimited Funds there. Your equity market is doing OK. It's negative this morning by about 0.1% on the S&P. With an update on stories worldwide with your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John. Wegovy maker Novo Nordisk sharing it is suing Hims & Hers Health for making knockoffs of its obesity medicines. The lawsuit alleges Hims is breaching its U.S. patent on semaglutide. Shares of Novo Nordisk are rallying in the early trade, while Hims & Hers are extending declines, down 17.5%. Meanwhile, House Minority Leader Hakeem Jeffries saying Democrats will not pass the Department of Homeland Security funding deal without getting a full reform of immigration and customs enforcement, known as ICE. The demands include prohibiting officers from entering private property without a judicial warrant and requiring agents to wear body cameras and ID badges. Lawmakers have until Friday to reach a deal. And Kroger is reportedly naming former Walmart executive Greg Foran as the supermarket chain's next CEO. Sources telling us here at Bloomberg, Foran would be the grocer's first CEO brought in from outside the company. The announcement is expected to come as early as today, as the nation's largest grocer looks to carve a new path after the unexpected exit of its former CEO. That's your Bloomberg Brief. John.
Hey, Yahira, thank you. More from Yahira later this hour. Up next on the program, turning up the heat on the Senate.
When Kevin Warsh was up to be a governor of the Fed, he got 100 votes. So I would say, why don't we get the hearings underway and see where Jeanine Pirro's investigation goes?
Up next on the program, we'll catch up with Henrietta Trays of Veda Partners, live from New York City this morning. Good morning. Coming into the week, believe it or not, the equal weight S&P at all-time highs after a rally of 2% last week. Same story on the Russell, 2% move, even with the volatility in big tech. Nasdaq futures this morning, negative by 1/3%, down just 1/10 on the S&P. Small caps softer by 0.1%. That's the story in stocks. Here's the story in the bond market. A story out of China. Our colleagues at Bloomberg reporting that China's telling Chinese banks to curb their exposure to U.S. treasuries. The move? Not even 2 basis points. The 10-year 422.59. And maybe that speaks more to what developed in Japan over the weekend. A massive blowout win for Takaichi.
Yeah, and really highlighting how her mandate to really make fiscal changes is significant and resounding, which raises questions why there isn't a more predictable reaction in markets, which is sell the yen, you're seeing the opposite, or potentially sell JGBs en masse. You're seeing a bit of an increase in terms of yields there, but not necessarily some wholesale exodus, which goes to the question, what's more important? Fiscal dominance or growth? And right now, people are saying maybe the growth side of things, in addition to more discipline, will really drive some strength there.
Japanese equities record highs overnight. Japanese equities rallying by close to 4%. Let's bring it back home. Under surveillance this morning, turning up the heat on the Senate.
I would point out that when Kevin Warsh was up to be a governor of the Fed, he got 100 votes, and that was led by his home state senator, Chuck Schumer. So, and Senator Tillis has come out and said he thinks that Kevin Warsh is a very strong candidate. So I would say, why don't we get the hearings underway and see where Jeanine Pirro's investigation goes.
So here's the latest this morning. The Trump administration ramping up the pressure on the Senate to be in confirmation hearings for the president's Fed chair pick. The Republican Senator Tom Tillis vowing to block any nominations until the criminal probe into Jay Powell is complete. Tyler Kendall joins us now for more. Tyler, welcome to the program. What will the Senate make of that suggestion from the Treasury Secretary?
Well, John, at this point, I'm not quite sure if it's really going to make that much of a difference, because at this point, Senator Tom Tillis is holding firm that he's going to block the nomination until the legal matter is resolved. And the Treasury Secretary here is appearing to suggest that the Senate confirmation hearing should happen in tandem with the DOJ's investigation, because this is a process that is going to take some time, right? Warsh needs to sit down privately with individual senators before his testimony. And I was on Capitol Hill last week, and I have to say, no one on the Senate Banking Committee could give me a timeline for when those meetings are going to be set or when that confirmation hearing date is going to be set. And while we still have time, of course, before Powell's term is up, if this standoff extends beyond May 15th, there are unresolved legal questions about what exactly will happen next year. Because while the Treasury Secretary is right, there is broad support among Republicans when it comes to Kevin Warsh's nomination. There is not broad support for the Department of Justice's investigation into Jerome Powell. In fact, we're seeing a mounting number of those on the Senate Banking Committee raise doubt that there is anything even to investigate when it comes to Jerome Powell's testimony before this very committee. Multiple of them told me last week that they do not think that Jerome Powell had any criminal intent in his testimony to them last year. Now, John, there's a few different dates and things that we could keep on the radar, but I will say I am closely watching for when we get to the deadline for the Federal Reserve to comply with the grand jury subpoenas that were issued. There are still some big questions about this investigation, including whether or not compliance is happening. But once we get that date, that could give us a little bit more of clarity or a timeline to look for about whether or not the DOJ is satisfied with the information they're receiving and whether they will ramp this up or tone it down.
A chorus of Senate Republicans pushing back over the last week. Tyler, thank you down in Washington. For more, Henrietta Trace of Vader Partners writes the following. Senator Tillis can and will hold up the nomination process, and he has the implicit but silent support of Republicans in positions of leadership. Henrietta joins us now for more. Henrietta, welcome to the program. Play this out with us. What if we're in exactly the same place that we are now in May, in a few months' time? What happens at the top of the Federal Reserve?
Yeah, I mean, that's a little bit of my concern here is I'm not sure why the administration is being so hard-headed about this. You really want for there to be a fresh slate at the Federal Reserve. And I think one of the biggest issues, and I hear this from clients all the time on the road, is that if you get Warsh confirmed through the Senate, through the Banking Committee, and then he goes to the Senate floor, and as Secretary Bessent suggested, he has been able to get unanimous consent from the members in the past. Jay Powell wants for this candidate to get robust bipartisan support. That's the goal. 80, 90 votes in the U.S. Senate. And that is achievable. And at that point, then you can have Jay Powell feel potentially comfortable stepping aside, clearing more room, and giving the president really what he wants. But instead, we're having this really contentious back and forth, and it's created this groundswell of questioning around whether or not Jay Powell would actually get off the board after his term as chair is up. And that's something that could be resolved, honestly, by some of these votes on the floor for Warsh and his confirmation.
But Henrietta, to John's point, what actually does happen logistically if we do not have Kevin Warsh nominated and sailing through the Senate at that point? Does the Federal Reserve current chair, Jay Powell, stay as the chairman? Or does the president get to put someone else as an acting Fed chair, which some individuals say that is a legal path forward?
Yeah, that's definitely what the White House is pursuing. That option creates a real pressure point that allows him to have his nominee there without having to go through the United States Senate. And that's I think when I have those conversations, those are the parlor games that are playing out. What we've seen from this administration is that they can try to stress test the legal argument. They will. So I think we should count on that being the route that they take from here.
Are you seeing anything in the Senate, especially with Senator Tom Tillis, that he's willing to maybe back down?
No, I'm not. And I've been really close with Senator Tillis's office for years now. The senator has taken a very strong stand. And I stand by what I wrote over the weekend to clients, which is Senator Tillis is doing the Lord's work for a lot of members who feel exactly the same way. They do not like what they have seen from the White House on Jay Powell. They do not like the pressure campaign on the Federal Reserve, whether it be with Lisa Cook or even back to the BLS firing of Erica McIntyre. But they don't like this extreme aggression from the White House. And so Tillis might be the face of all this. He doesn't have to run again for re-election. But the other members behind the scenes, including the chairman of the Banking Committee, Tim Scott, do not like what they're seeing out of the White House.
Henrietta, there's a larger point here, and I think it's an important one. How much is there a groundswell of pushback to President Trump that could make itself much clearer, even in the Republican Party, after the midterm elections? Do you feel that starting to build, or is this just sort of a one-off issue where the Federal Reserve's independence is sort of a different kind of topic?
I think that both of those are true. The Federal Reserve is very much a different kind of topic, and members know that the Fed chair is an incredibly important, needs to be, overwhelmingly accepted. Very unlike a Supreme Court justice, for example, who you can get in with 50 votes and J.D. Vance breaking the tide. Nobody wants that for the Federal Reserve. So that's the first piece. The second piece actually has two layers. As we get beyond the primary election cycle and into the general, where a Republican will have to run against a Democratic challenger, especially in this cycle, where the president is materially underwater on handling of the U.S. economy, of prices, inflation, jobs, and immigration now, those Republican candidates have to start deciding whether they want to run very closely tethered to the president or if they want to pull away and try to win a general. That's going to happen even before we get to the post-midterm period and get into the 2028 cycle of who's going to be the front runner for the Republican candidacy. Is it going to be a J.D. Vance style candidate that will keep the MAGA mantle, or are we drifting into a Todd Young, Josh Hawley, and maybe a middle ground foreign policy focused Marco Rubio? Those questions are all coming our way, and they start when we get into the general election of this year, not just the primary season we're in right now.
Starting to see just a bit of pushback, aren't we? Henrietta, thank you. Henrietta Trey's there, Aveda Partners. So the chairman's last meeting is at the end of April, and we've got some time before we get there. He steps down in May. Possibly. I've got no idea. But you can start to envision a situation where this mess is not sorted out by the time we get to the Fed's April meeting.
And we don't really have a sense of what the clear path is ahead. I mean, if you do get a Fed chair that presides over presumably his last meeting in April, and then there is no Fed chair, does he just stay on, or does it become the Waller Fed in the meantime as one of the governors take the helm? Ultimately, the lack of clarity here is going to become messy for markets as we get closer to this event.
I wonder if it becomes so messy for markets that you have Senator Tillis back down, or the White House putting pressure on the DOJ and saying, all right, you need to wrap this up because we need to move this train along.
It only gets messy for markets if markets actually want something from the Federal Reserve. And I don't think we're there just yet. If the data continues to worsen, then we're in a very, very different spot with regards to the Federal Reserve. But at the moment, if the Fed was to have a meeting tomorrow, I think that meeting would still be a little bit meh for a lot of market participants.
Depends if Warsh's commentary changes the picture in terms of what he plans to do. If we get a sense of who this Kevin Warsh really is.
That could change with a little bit of payrolls data on Wednesday and CPI on Friday. Richard Clarida joins us next. Equity futures this morning down by 0.1% on the S&P following a super volatile week last week, which closed with the biggest one-day gain since May on the S&P 500. The regional banks are the story for me, though, up every single session through last week, Monday through Friday. The regional bank stocks, record highs, and up 7% last week. Will this economy hold up and justify the rally in the bond market? 2-year and 10-year yields lower on the week just marginally. The 2-year at 349.75. A tug of war between ISM manufacturing, services, and some weaker than expected labour market data. And we'll get some extra data later this week, which will breathe some life into the debate of the past few days.
We get finally the non-farm payrolls report for the month of January, as well as some of the benchmark revisions to the quarterly household survey, which is going to be really interesting in order to get a sense of the broader 2025 picture. We've gotten weaker employment data, and it hasn't really meant much for the reacceleration. So what do we do if we get data that shows weakness or that shows strength? Can we infer anything about the momentum that we're seeing under the hood in some ISM services and, frankly, in a lot of the earnings as well?
10-year bond yields this morning up just 2 basis points, just about unchanged at 4.23. Let's count you down to the opening bell. 2 hours away with some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. It's the drama between Hims & Hers and Novo Nordisk. First, Hims & Hers comes out with a cheaper GLP-1 pill, around $50, and then Novo Nordisk sues them, and then the FDA says that they're investigating, going to ban those copycat medicines. Well, over the weekend, Hims & Hers saying they will not be selling those pills. Hims & Hers taking a beating on that, down almost 20%. Novo Nordisk, those ADRs in the U.S. rally some 5.5%. Meanwhile, Kroger's has confirmed that it will have a new CEO. Greg Foran, coming from Walmart, largely credited with turning around the U.S. business at Walmart, making it more friendly, making it more bright. The previous CEO of Kroger was ousted because of an investigation into personal conduct, so those shares up 5.2%. Finally, ST Micro, the semiconductor company, reaching an agreement with Amazon, will be supplying it with semiconductors. STM has seen largely behind on the AI data infrastructure race, so this is a boost to get it there. Also, this allows Amazon about 7 years where they can buy STM stock. So again, shares moving on that news up more than 6.5% in the pre-market, John.
Hey, Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, Chinese regulators advising banks to curb their holdings of U.S. treasuries. Officials framing the move around diversifying market risk rather than geopolitical maneuvering or loss of confidence in American credit. Elsewhere, the Goldman Sachs trading desk sounding the alarm, saying the U.S. stock sell-off is not yet over. The team warning of more trades from trend-following algorithmic funds. They say a renewed decline could trigger $33 billion in selling later this week. And finally, President Donald Trump taking ownership of the current U.S. economy after months of blaming the Biden administration.
The one thing that they don't say anymore is affordability, because I fixed the problem that they created.
You said you inherited a mess from President Biden when it comes to the economy. But at what point is it on you? At what point are we in the Trump economy?
Oh, I'd say we're there now. I'm very proud of it.
The president predicting an economic boom this year, saying in a recent cabinet meeting growth could reach, quote, numbers that have never been hit before.
This goes in counter to a number of different polls where people aren't necessarily feeling it, and they feel fairly negative on average toward some of the developments. It raises a question. And this, just bear with me. If you're a conspiracy theorist, sometimes President Trump comes out with things ahead of data releases because he's seen the data. Does this mean that the data is going to actually be better on Wednesday? Or is this signifying more stimulus down the pike, especially if we don't have that kind of boost? In other words, how much of a commitment is this to trying to make this a good economy this year, regardless of anything that develops?
I think the president is just trying to market what he's doing, given the fact that this is the Super Bowl, of course, interview that he knows millions of Americans are going to have their eyes on. What I do think is interesting, though, is that they are taking ownership. I was looking back at our March interview with Howard Lutnick, where this entire phrase came to be. We were questioning him about the data, and I think he turned around to you, Jonathan, and said, you're looking at Biden data. That is not Trump's data. And at this point, now this administration, we are more than a year in to Trump's second term. They are now owning this data, and they have to.
There are many lessons from the Biden administration. Number one, don't gaslight the public. They'll see right through it, and you'll get punished at the polls when the voting comes around. And I think the administration is very, very aware of where this economy actually is and the way people feel. Otherwise, you wouldn't have seen this pivot at the back end of last year coming into this year and leaning into some very populist ideas ahead of the midterms.
So what's next? If people still feel this way, right, how much are we going to get proposals to try to offset what people are still feeling? Because people aren't feeling like this is the best economy in the world.
Well, Friday night, it might have been missed by a lot of individuals because it came out late, but there was a directive from this White House about beef imports. Now, this is going to hurt farmers and cattle ranchers. They are upset. They need those high beef prices because of what is going on right now in reduction we have in cattle, but they are letting more Argentinian beef in. And do you know why that is? It's because beef is at record prices, and this continuously shows up in polls. Higher groceries, it's a problem.
Inflation data coming this Friday. Jobs data, of course, this Wednesday. Let's turn to the Federal Reserve. The U.S. Treasury Secretary Scott Bessent sharing his expectations for a Kevin Walsh-led central bank.
It was pretty clear to me. I wrote a 7,000-word essay in the International Economy magazine. I called it gain of function monetary policy.
That's right.
Saying that the Fed had gotten kind of out of control. And I think that Kevin Warsh is going to be very independent, but mindful that the Fed is accountable to the American people.
The former Fed Vice Chair and Global Economic Advisor at PIMCO, Richard Clarida, writing, Warsh has argued for a new Treasury-Fed accord that could provide a framework for the Fed working in tandem with the Treasury to shrink the size of the balance sheet. Rich joins us now for more. Rich, good morning.
Good morning.
Want to give you some more time to explain how you're thinking about an incoming Chair Warsh and what might change at the institution you worked at for so long.
Well, thank you for that. Look, Kevin Warsh I've known for a dozen years. He's accomplished. He's respected. He has a paper trail, and he's been quite specific in his assessment and in many cases criticism of Fed practice, really along three dimensions. The balance sheet he thinks is too big. The Fed has gotten into credit allocation and mortgages. He's been critical of forward guidance information the Fed provides about future rates. And he's been critical that the Fed has not really anchored its policy in policy rules. And so over time, not on day one, but over time, Jonathan, we could see the Fed adjusting policy along all three of those dimensions, including the balance sheet.
Well, let's start with communication and then turn to the balance sheet. The post-GFC Federal Reserve and the communication apparatus, I'm sure there were certain things that you were frustrated with yourself when you were at the Federal Reserve. What would you like to see change? And what do you think ultimately Kevin Warsh will change?
I think there are a couple of things I would highlight. First of all, it's very possible to run a successful monetary policy without any forward guidance. Paul Volcker did it for 8 years, and Alan Greenspan did it for his first 17 years. Forward guidance providing information about future rates really came into focus at the Fed in the global financial crisis. Rates were at zero, and the markets kept pricing in rate hikes. And so the Bernanke Fed said, we're not hiking rates. And so I think it is legitimate for the Fed to have a conversation and discussion about the costs as well as benefits of forward guidance. It could be about the dots. I think it's more than just the dots. So I think that's probably a direction they'll move, but it's not going to change overnight.
So I'm just thinking, is this basically going to spike the dots? And you're saying, well, that's a big part of it. I mean, do you expect there to be some sort of limit on how much other Fed members can speak, right? So there's this question of how much the Fed has been dominated by the person at the top.
Yeah.
It has always been the Bernanke Fed, or what we got with respect to Fed Chair Powell and the Powell Fed. Yeah. Is this going to be the Warsh Fed, or is there going to be a different dynamic given some of the dissents that we're likely to get?
I think it will be the Warsh Fed. I think it's helpful that Kevin knows the institution. I think that will be important in terms of shaping it in his direction, but it will take time. As you point out, it's a good question. The chair has the power of persuasion, but at the end of the day, he or she only has one vote. Congress set up the Fed to require that interest rate decisions, hike or lower rates, require an affirmative vote of a committee, and the committee has 12 members. Now, in the time we've all been following the Fed, the chair almost always gets his or her way. But if you go further back, we've had situations where the chair has been outvoted on both discount rate and federal funds rate changes. I'm not predicting that, but what I am saying is Kevin Warsh will have to work with the committee and will have to bring the committee along with him if he wants to make the changes that he says he wants to make.
Does the committee include Treasury Secretary Scott Bessent? And I ask this because we're talking about a potential accord between the Federal Reserve and the Treasury. We also have heard Treasury Secretary Bessent talking about Fed policy, what he expects them to do with the balance sheet, which raises this issue of whether, as Krishna Guha says, he has a soft veto over what Kevin Warsh would do. I mean, what's your sense of what this looks like?
Well, it's a complex issue, but let me distill it. The Fed balance sheet and profitability is ultimately consolidated with the Treasury. And so ultimately, the stock of Treasuries outstanding is going to reflect the issuance that Scott Bessent oversees and the Fed's programs of quantitative easing. And I think it is appropriate to have a discussion with the Fed and the Treasury over time about the way to balance off the objectives of the securities outstanding. without, of course, impinging on the Fed's ability to set monetary policy. It's possible to do that. The Fed could run monetary policy with a much shorter duration portfolio, as was the case before the global financial crisis. And also, remember, if you go back to the early days after the global financial crisis, the Fed was actually talking about selling securities and very quickly getting back to a small balance sheet. And so these are complex issues. It's not going to change overnight, but I think they are legitimate areas to have a conversation.
They're not going to change overnight. And the Treasury Secretary made that clear in his interview over the weekend. He said, I wouldn't expect them to do anything quickly on the balance sheet. So what kind of timeline are we actually looking at?
Well, given that the Fed's been talking about this off and on for 15 years, it may be a very long timeline. And in particular, the Fed has made the decision, which could be changed, that it does not want to sell any securities. And so when the Fed is shrinking its balance sheet through so-called QT, it's not selling anything. It's just letting existing securities roll off. Other central banks do sell assets. The Bank of England regularly sells gilts into the gilt market. The Fed itself has talked about selling mortgage-backed securities. And so these are all ideas that have sort of been in the conversation at the Fed for a while, but it's not going to happen overnight.
The Trump administration says they want to take politics out of the Fed. We just heard from Bob Elliott. He was saying how Kevin Warsh isn't hawkish or dovish. He's a political animal. I don't know if you saw over the weekend, but there was a chart really going all over Twitter where you could see his rhetoric changing depending on if it was a Democrat or Republican in the White House, especially depending on if he was maybe in the running to be Fed chair, how dovish he became. What do you make of that, given how long you've known him?
I didn't see that chart. What I would say is the Fed under Jay Powell in the last year and a half has been cutting rates, and the dots, those infamous dots in December, showed that a majority of the committee thought at least one rate cut this year would be appropriate. And so I don't necessarily infer anything other than Warsh sees the economy as the Fed did, at least in December. I do seem to remember Kevin not being entirely complimentary of the Powell-Clarida Fed either during my time there. So I don't think it's entirely driven by any of those considerations.
Rich, can we finish on Torsten Slok of Apollo? He put out this over the weekend. I'd love your reaction to it. He said the US economy is about to take off. Later this year, the conversation in markets will change from talking about Fed cuts to instead talking about the Fed having to hike. What's your reaction to hearing that?
I think I've said on this show, I think there is an upside case for the economy this year. The tech Capex boom is real. There will be those big, beautiful bill tax cuts that people are getting. Foreign companies are building plant and equipment in the U.S. Whether or not Powell was asked that question perhaps by Mike McGee at the press conference recently about rate hikes, and he more or less said that's not something that we're thinking about right now. But it gets to the forward guidance issue that we discussed a moment ago. It may well become part of the conversation if we get an economic boom this year, especially if inflation doesn't return back towards the target. And at that point, the forward guidance, the skepticism about forward guidance that some have indicated, including Kevin Warsh, may come to a test.
Rich, it's good to see you. Always great to catch up. Thank you, sir. Richard Clarida there, the former Fed Vice Chair and now back, of course, over at PIMCO. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Joining us now, here's Yahara. Hey, Yahara.
Hi, John. In Japan, Prime Minister Sanae Takaichi secured a historic election win, her Liberal Democratic Party winning a two-thirds supermajority in the lower house, which positions her as the nation's strongest leader in decades. In remarks, Takaichi vowed to build trust with financial markets amid concerns over how she'll pay for a planned tax cut. Meanwhile, here, a federal judge ordering the Trump administration to unfreeze funding for the Gateway Rail Tunnel project after construction shut down due to a lack of funds. This came after the White House offered to restore funding if Senator Chuck Schumer pushed to rename Dulles Airport and New York Penn Station after the president. And if you didn't stay up late enough, the Seattle Seahawks are Super Bowl champions after a dominant performance over the New England Patriots. Seattle held New England scoreless until the fourth quarter, finishing the game with 6 sacks, 2 interceptions, and a fumble recovery. Running back Kenneth Walker was named MVP after rushing for 135 yards. It's the second title in Seattle franchise history. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. Up next on the program, questioning the AI trade.
There's not just questions about valuations, but it's actually the models. Can they actually deliver? Which part of the market? Could they cannibalize themselves, etc.? So increasingly for investors who once upon a time could see this as a one-way trade, this is really about dispersion.
Up next, we'll catch up with John Belton of Gabelli Funds from New York City. You're watching Bloomberg TV. Let's start with the scores. Equity futures negative by 0.1% on the S&P. On the Nasdaq 100 down by a third. Massive volatility for tech stocks last week. Huge numbers as well. $650 billion of Capex intentions announced by some of these guys. And a big one coming from Alphabet. Google. Alphabet this morning kicking off a 7-part dollar bond sale. That is going to be closely watched after announcing $185 billion of Capex just last week.
Yeah, how does the market handle this? We already dealt with Oracle's bond sale. It cleared. How does the market handle a 100-year bond sale from Google, which evidently there is a pound-denominated tranche that's 100 years long? I mean, how much do we get people bidding into 15-year Alphabet debt at a time when they clearly need the money? It used to be they didn't need the money. Now they're selling bonds because they actually need it for some of their Capex ambitions.
When credit and credit issue, this big issuance comes through, sometimes it kicks around the Treasury market, and you're seeing that this morning. Yields up by an extra basis point, 424 on 10s. That's a lot of supply to absorb, and something we'll closely watch through today's session.
And who's going to buy it, and how are they going to finance it, and how much are they financing it on the longer end of the Treasury curve, given the fact that some of these tech behemoths have leaned on long-duration bond issuance. I mean, think about this. Long-duration bond issuance to buy Nvidia chips that are going to go out of date in 3 years. I mean, it just sort of highlights the situation. It's like a sieve.
US Treasury issuing debt later this week as well, 10 and 30-year bond issues. So lots of supply coming this week, going into CPI on Friday and payrolls on Wednesday. Under surveillance this morning, questioning the AI trade.
In Q3, Q4 of last year, the narrative around tech and AI was really about questioning of valuations, about bubble, the Capex spend. And now you're seeing it shift even further, so that there's not just questions about valuations, but it's actually the models. Can they actually deliver? Which part of the market? Could they cannibalize themselves, etc.? So increasingly for investors who once upon a time could see this as a one-way trade, this is really about dispersion.
So here's the latest this morning. Waking up following a massive week of volatility. Nasdaq 100 wiping out $700 billion in market value. John Belton of Gabelli Funds writing valuations have had a healthy reset. Longer term, the reality is that, as always, there will be winners and losers. John joins us now for more. John, welcome to the programme, sir. Can we live in a world where Capex is both a waste of money and AI is ridiculously disruptive?
I don't think so. I think that's why you're seeing these types of Capex numbers, because this technology is very clearly transformative. It's already got a couple major commercial use cases. I think so far we've seen digital advertising, digital commerce, cloud computing, and now it seems like software development are three massive use cases that are already proven. Many more to come, but I think that's why you're seeing these huge Capex numbers.
John, last week in the price action, as you know, a lot of people were preoccupied with the pain, the disruption. What about the benefits? Where are you focused on the benefits?
Well, again, I think I'd go back to the comment I just made, where clearly digital advertising, the big giants in digital advertising, specifically Alphabet and Meta, clear beneficiaries. These are several $100 billion ad businesses that are re-accelerating at that kind of scale. That's kind of amazing to think about. So I think that's beneficiary number one. And the way they're using AI to support these businesses. So it's not just about delivering the right ads in front of the right people and defining those audiences. It's about automatically generating ads and making the process easier for their advertisers. So I think there's still so much to be done in that area. And then I think cloud computing is the next, and that's obviously a broad term, but you're seeing these cloud businesses from the likes of Amazon, Alphabet, Microsoft, and Oracle similarly reaccelerate at $100+ billion scale. So I think those are the early beneficiaries seem pretty concentrated in those areas, and I think we'll see how that unfolds going forward.
John, if you buy, and I think a lot of people do, that AI is going to change the world and be incredibly profitable for companies that are able to adopt it, that's one thing. It's another thing to say that the multiples that we currently have on some of these tech stocks are justified based on the fact that they're no longer asset-light companies. They are increasingly incurring debt. Google is selling debt now with 40-year maturities in the United States, according to this latest prospectus. And suddenly they're burning through cash and not able to buy back their shares. How much does that make you have to re-rate some of the valuations on these stocks, regardless of the view forward on AI?
Yeah, I would just clarify a couple things you said. So first of all, none of these companies are burning cash right now, right? I think Oracle would be the one exception among the big cloud companies. But, Meta, Google, Amazon, Microsoft, these are still positive free cash flow companies. They're still, 30+% operating margin companies. So I don't think, yes, they are in an investment cycle. That is true. But burning cash, I think, overstates, the extent to which they're spending. And then I think you look at these balance sheets, these are all by and large net cash balance sheets. So I think issuing debt, that's just a matter of capital structure optimization. That's just a prudent way of optimizing the mix of funding for these businesses. So these companies have no balance sheet issues. They have no cash flow issues. And in terms of valuation, I think we'll stick with the Mag 6. Being Alphabet, Amazon, Microsoft, Meta, Nvidia, and I forget who else I'm forgetting right now, but I think at least 3 of those companies are trading at a below market price earnings ratio, and valuation is not an investment thesis in and of itself, but I really don't see valuation or balance sheet health or cash flow as a big risk right now. I think the risk is more so, are these earnings estimates for the next couple of years going to prove too lofty? And are they going to be able to deliver on the technological progress that AI does offer?
Hey, John, this was super well framed, and we appreciate your time. Thank you, sir. John Boughton there of Gabelli Funds with an important point on Alphabet at the end. Alphabet tapping the US high-grade bond market, looking to issue a 7-part bond sale through today.
Yeah, including a 40-year piece that's priced 1.2 percentage points above Treasury. So if you want to know why long-term Treasuries are selling off in response to this, it's because evidently Google is a competitor to the U.S. government for your dollars, and maybe some people would prefer to put it with Google. We shall see. This is going to take place today.
The Oracle debt was taken down really well in the last week, so another test for the debt market from a company with a much more healthier balance sheet, Alphabet. Coming up on the programme, Jill Carey-Hall of Bank of America, Frank Lee of HSBC, Luke Tilley of Wilmington Trust, Austin Kwon of Wells Fargo. The third hour of Bloomberg Surveillance up next.
There are lots of cross currents. This isn't just about software. This isn't just about AI.
Everybody says there's insatiable demand for AI. I'm not sure we're quite seeing that yet.
There is a lot of companies that are going to benefit significantly from the AI build.
It does feel, though, that we're starting to approach maybe the end of that sell-off.
This is such a generational transformation. We're going to live in this bumpy ride.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures down not even 0.1% on the S&P 500. The Nasdaq down by 0.2. A week that is stacked with economic data, including retail sales tomorrow, payrolls Wednesday, claims Thursday, and then CPI coming up on Friday.
This is going to be the data that we've been waiting for. Whether it gives us clarity is another question, but it really was emphasized last week how important it is for the U.S. economy to remain strong, for the overall index to not fall out of bed. Because even though we saw huge drawdowns in some of the tech stocks, we saw a basically flat market because of the strength in the cyclicals. Can this continue? It really hinges on the real economy.
Down just 0.1% on the week on the S&P, which is crazy to think about, within 1 percentage point of all-time highs.
And what's going on in terms of the data that everyone is looking forward to, the scope could not be wide. -10 to upwards of 100,000 are right now, when you look at our street economists estimating 69K. But the more important for this data is it's going to be clean after a massive government shutdown. And then right after that, we're going to get CPI. So putting this all together, I think is what the market's going to be focused on.
Plenty of people out there still really bullish on the US economy, the rate cuts we've already had, the tax refunds we're about to see, and this $650 billion of Capex coming from 4 companies. And this is what's happening in the debt market. Equity side of things up by 0.6%. Alphabet on the debt side, a 7-part dollar bond sale announced by the Google parent company just moments ago.
It is going to be, I can't emphasize enough how important it is to watch how this debt is received in the market. As you were mentioning, John, Oracle sold its bond offering and it was cleared in flying colors through markets. Investors definitely were welcoming the bonds. Do we get the same dynamic from Google? Google has a better balance sheet. Google has a better story to tell even than Oracle does. Do they get the kind of spreads that they're looking for? And if they do, does that say green light to all of those Capex spending plans because the capital markets will finance that?
They're funding a lot of that through cash flow anyway. These are cash machines, some of these companies, but there is a lot of paper that's going to be issued this year. The Treasury, corporate America, and we're going to get some big IPOs as well. That's in the mix when we have this conversation too. Anthropic being one, maybe OpenAI, SpaceX another. These are some of the biggest IPOs this country has ever seen, and everything feels like it's coming all at once.
And it raises the question of how much capital markets will tolerate some of the hopes and dreams of the big tech names and, frankly, the whole broader space. Right now, they are showing some nerves. And that, I think, is the reason why people are saying watch each consecutive debt sale. If there is one that does not clear, watch that to trickle out in magnified form throughout all of markets. This really is important to watch.
We've got a lot of supply to absorb this week, including issuance from the Treasury, 10s and 30s, 3s as well, I think, through the week. Yields a little bit higher this morning, up by 3 basis points on 10s at the very long end of the curve on a 30-year maturity. Yields up by 4 basis points to 4.89. Coming up this hour, we'll catch up with Jill Carey-Hall of Bank of America with stocks edging lower, frankly, of HSBC, as Nvidia is silencing the latest AI concerns, and Luke Tilley of Wilmington Trust previewing a big week of economic data. We begin this hour with stocks wavering following a volatile stretch for big tech. Jill Carey-Hall of Bank of America Securities writing, given the risks, investors may be best served looking for inexpensive opportunities that have overly discounted the risk or that are AI beneficiaries. Jill joins us now for more. Jill, good morning.
Good morning.
It's good to see you. Where does that take you? Where do you land?
Well, I think, with respect to software within the Russell 2000, where, overall we've obviously seen a big correction in the broader software industry. And I think the sentiment is obviously still uncertain there, but still, given how much it's sold off, certainly some opportunities. I think, within the Russell 2000, though, where potentially some bigger opportunities could be are areas that, are still inexpensive. And, given the ISM print that we saw last week, this is something that has been highly correlated not only to corporate earnings, but to relative performance of small caps relative to large caps. And I think, that manufacturing recovery can help sort of cement investors' confidence in the earnings recovery and benefit some parts of small caps that, are historically more sensitive to the ISM.
For us, that's what's changed coming into 2026. The small cap story through the Russell has been less about rates and much more about the economy. Are you seeing the more cyclical parts of the market more broadly pick up in anticipation of a pickup in economic growth?
Well, I think we've generally seen, a broadening out of, even within the Russell of what's been working so far this year. And, I think within small caps, there are areas like financials and energy that are still, even though the Russell 2000 is now trading a bit above its historic average valuation multiple, those are areas that are still cheap. Financials in particular is still ranking very well in our work. And these are areas that historically, when the ISM has crossed above 50, these have been areas that have historically outperformed.
Is this entirely driven at this point about the economy? And is it fair to say that any kind of rate cutting cycle has already been fully priced in to this particular sector?
Well, I think, it's important that we still get rate cuts this year. Our economists are expecting to, and the Russell 2000 has been extremely sensitive to Fed expectations. So I think the fact that, we've been discounting Fed cuts, and if we get those Fed cuts, that'll be enough to support the Russell. But if we start to get cuts priced out or even expectations of hikes, then that becomes a lot more challenging because the index has been so highly correlated with the Fed and data that feeds into Fed expectations.
It's not just small caps, it's all of the cyclicals that have really been outperforming. And some people can say, as Max Kettner did earlier today of HSBC, this is going to continue and it's going to keep driving optimism in the overall index. Jim Reed, as John was mentioning earlier, talks about how this is very similar to 2000, where you saw that rapid broadening out in the first 6 months of 2000 and then the rest is history. Why are you confident that this is going to be more of the Max Kettner version of things, where this is sustainable, even if you get those potholes in some of the big tech names?
Yeah, I mean, even within the S&P 500, even though earnings growth will still be driven largely by tech this year, we and consensus are expecting that you see, a deceleration of earnings for the Mag 7, the big names, versus a pickup for the rest of the market. So, within the S&P 500, we're more bullish on the equal-weighted S&P 500 than the cap-weighted index. And then, even down in small and mid caps, that's where the big earnings recovery is expected to be after we were in this prolonged earnings recession, manufacturing downturn. So I think, we were in a period where that earnings recovery kept getting pushed out, especially for the small and mid cap segment. So I think if we continue to get data like the ISM we just got, that helps cement investors' confidence in this earnings recovery and more cyclical recovery. And the fact that corporate guidance has actually been pretty supportive, I think gives us and can give investors a little bit more confidence this time around. Usually at the beginning of the year, guidance is very weak. Corporates have incentive to be conservative, but it's actually been much stronger than it usually is in January and February. So that's been an encouraging data point as well.
One reason why there has been also optimism is because capital markets have been wide open. It's being tested right now. The capital markets collectively, based on all the activity that's expected, John laid it out earlier, and we're now getting debt sales that are only escalating to finance some of the Capex ambitions of the big tech names in particular, but more broadly. How important is it for all of these sales to go well in order to keep some of the optimism in the rotation and just frankly the growth trade in the United States?
Yeah, I mean, I think, some of the ones that you mentioned will be important to watch. And I think just, the hyperscalers, if they are becoming more, levered in general, these stocks have become so capital intensive, in many cases more so than even the oil majors. And, typically big Capex spenders historically tend to underperform. So, what we've seen in recent years has been an anomaly versus what typically happens. So, I think there's a lot more focus on, that aspect of things. And I think in general, with the M&A and IPO backdrop, that's going to be, impactful to watch. Everyone had kind of been expecting that we could see a pickup this year if economic growth and conditions remain supportive. I think it's not necessarily for something like small caps, will the outlook for the Russell 2000 hinge on M&A or IPO backdrop? Not necessarily. We haven't necessarily seen that historically, surprisingly. The Russell's actually underperformed more frequently than it's outperformed in years where we've seen heavy M&A activity. But I do think, for certain sectors, especially if we see an M&A pickup in financials, regional banks, that can help sentiment there. Tech and healthcare. Healthcare has been an area where we did see a lot of M&A activity, but case for that to continue. IPOs have been, an area that's been a bit more challenging for small caps because a lot of companies have been staying private longer, going public larger. So, I think the opportunity set for small caps has become a bit more narrow, and the growth backdrop for small caps is not necessarily what it once was, in the 90s, early 2000s.
Joe, you put a lot of emphasis on the ISM manufacturing, but how much of that was because of what we saw with basically the inventories being drawn down?
Well, I think overall, if indicators like the ISM and just the demand backdrop, I think if we continue to see reshoring of U.S. manufacturing, anything that leads to a continued prolonged Capex cycle in the U.S., small cap sales growth is highly correlated with U.S. Capex growth. So, I think that overall, any of the indicators that suggest that story is continuing should be kind of a positive multi-year story for domestic small and mid-cap companies. 20s. So, I think we'll continue to watch those indicators, but the fact that we finally came out of this, manufacturing downturn and potentially that continues, is something that had been one of the bear cases for small caps this year if that doesn't occur.
Is there any tension between what's happening with small caps and what's happening with staples at the moment on the S&P?
With consumer staples?
The fact that they're up 14% year to date.
Yeah, staples is an interesting one. I mean, within our large cap work, we had recently upgraded consumer staples in our year ahead. It's obviously been kind of this bombed out sector. And, now potentially you're starting to see kind of guidance, second derivative turn in terms of revisions. Even within small caps, it's been ranking better. I mean, if you see pockets of tariff relief that benefits staples. And so I'd say that's one sector. Even when I looked at the ISM, that's been kind of the one defensive sector, even within small caps, that actually tended to do well after the ISM crossed above 50. So that's one that, even though some of our preferences have been for more of the cyclical sectors, that is one more defensive sector that we do see potential for recovery. And if there's a focus on affordability, for low-income consumers who have struggled, potentially we see those tailwinds there.
One to watch. Jill, thank you. As
you.
always, thank you. Jill Carey-Hall there of Bank of America. Speaking of recoveries, the S&P 500 no longer negative on the session. We're just about unchanged on the S&P. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. We're seeing Alphabet shares edging lower after the tech giant announced a $7 dollar bond sale. It's the latest in what's been a borrowing spree by companies at the forefront of the AI investment boom. Sources telling us here at Bloomberg, Alphabet is also offering debts in pound sterling and Swiss franc denominated bond. And Bank of France Governor Francois Villeroy is stepping down from his post. Villeroy is set to leave office on June 1st, more than a year before his mandate ends. The central banker saying his decision to leave was personal, and he plans to take over as head of a foundation. And moving on to golf, which was surprisingly more exciting than the Super Bowl. Chris Gotterup won the Phoenix Open this weekend, defeating Hideki Matsuyama in a playoff. Matsuyama entered the final hole with a one-shot lead, but struggled off the tee box as Gotterup drilled a long birdie, securing the victory. This is Gotterup's second win on the PGA Tour this season. That's your Bloomberg brief. John?
This I did actually watch, of course.
I can tell. Look at your face.
No, I'm laughing because I just felt like it was just me and maybe five other people.
I don't think so. I'm pretty sure that Yahira also, and I think a lot of other people as well. People looking for excitement.
I was wondering how this got into the news, and I was like, oh, of course, it's probably the only thing John watched this weekend.
I didn't make this happen. It was pretty funny. Because if this had carried on, I still would have watched this instead of the start of the Super Bowl.
Oh, I know that. But you know what the truth is?
Just supporting Jim Nantz over at CBS.
But I think that actually wouldn't be the only one. I mean, I was watching figure skating, so there you go.
Up next on the programme, the Morning Calls Plus, Frank Lee of HSBC as Nvidia is silencing the latest AI concerns. That conversation just around the corner from New York City this morning. Good morning.
I think it's important with the software names to take a step back and think about the technicals because they are very, very oversold. I think the big question is, can software regain its leadership coming out of this bounce? I think that's a lot more in question just simply because there's all these doubts of things that effectively software companies can't disprove at this point because it's AI risks that could be out 1, 2, 3, 4 years in the future.
That's part of the difficulty right now. That was Cameron Dawson of New Edge Wealth, joined us a little bit earlier on this morning. If you're just tuning in, welcome to the programme. Equity futures on the S&P 500, just about negative. No drama, though. We're down about 0.1%. Drama-filled week last week on the Nasdaq 100, the worst week of the year so far. This morning, down another 0.1%. That's the price action. Let's get you some morning calls. First up, Medius downgrading Microsoft to hold, expecting free cash flow to dip in the near term. Elsewhere, JP Morgan raising its price target on Cisco to 95, citing accelerating revenue growth. And finally, D.A. Davidson upgrading Oracle to a buy, saying it will benefit from OpenAI exceeding expectations this year. That stock's bouncing back. It's up by 5%. In focus last week after a big debt issue from that company, taken down really well. Speaking of debt issues, we will get one from Alphabet, the Google parent company, kicking off a 7-part US bond sale through this morning.
Yeah, including a 40-year tranche. This follows, as you mentioned, the $25 billion sale of Oracle debt that went quite well. This is expected as part of at least $40 billion of investment-grade bond issuance in the United States so far this week. A very heavy slate ahead. And really, it raises a question of how differently each of these issuers will be treated. In other words, are there going to be winners and losers when it comes to these sectors, and how easy it is to clear the bar for debt investors who are seemingly okay with the debt issuance that they're coming out with, because they still are cash cows and they aren't necessarily negative profiles, even if equity markets are concerned. One
of the winners should be Nvidia. As the headline crosses the Bloomberg that they're looking to raise $15 billion over at Alphabet, one of the winners should be the chip players. They're going to be spending a fortune on Capex. Who wins? This is what was odd about last week. As these Capex intentions rolled out, and the fact that we were seeing Broadcom and Nvidia up until Friday trade really soft on the week, it was just really difficult to get my head around. Aren't they going to be spending money on the chips these guys produce?
It seems like people finally got around to asking that question and answering it and saying, yeah, because on Friday we saw some of that rebound. Does it continue? Because ultimately a lot of this Capex is going to go to buying the latest generation of chips, and frankly, not even buying them, solidifying their order books for future deliveries. So definitely a lot of people thinking the same thing that you are.
Frankly, if HSBC has a buy rating, 320 price target on shares of Nvidia, I'm pleased to say that Frank Lee joins us now for more. Frank, welcome to the programme. Last week was curious. We had this drip feed of massive numbers coming from big tech, and yet some of the major chip players were trading soft through the week. Could you make sense of that, Frank?
Sure. I think what you've seen over the last couple of months, though, that there's already been a little bit of an AI diffusion trade. So, Nvidia and Broadcom have been underperforming overall for the last few months, as the market has shifted to things such as the memory shortage with the ongoing price hikes. That's offering better near-term earnings momentum as prices keep going up almost every month. We're also seeing, a bit more focus on AI networking. So you're seeing names like Coherent and Lumentum. They're seeing very strong earnings beats and guidances, very similar to the way people start looking at the ASIC story. So I think that's part of the reason is there just seems to be, more growth in other areas relative to the big blue chip semi names that started off this AI cycle.
So, Frank, that raises the question just how these names will perform when these big IPOs materialize later this year. Anthropic, OpenAI, what's going to happen to the story of yesteryear?
Yeah, so I think, what we need to see really, if you look at the Capex spend of these big hyperscalers, what was interesting was that the initial reaction was some muted, because even though we saw $150 billion of incremental Capex since the beginning of the year for 2026, I think there's some debate about how much of it is going into the actual GPU and the ASIC chips, because one thing that we've also seen is memory has seen a significant, almost, once in a generation upturn. So that is driving a lot of revenue revision on the memory names. So if you look at how much memory revenues have been revised for 2026, it's also been about 150 billion. So it's almost a one-to-one match, meaning that the incremental Capex we saw seems to be going some of it to the memory space, and how much is left over for the, for more upside to the memory, to the actual chip guys like Broadcom and Nvidia. I think that was a question the market was contemplating earlier.
So what's the answer, Frank? Do you think that ultimately this is going to go more to the Qualcomms of the world or even the Samsungs, or do you think that ultimately there's a lot more to flow up to the top of the chain?
I think what you need to see is two things. I think the velocity of these price hikes on the memory side, as it starts to kind of level off, that will be good for the original AI chip guys, because then I think we'll see this increased spending come back to the original chip makers. And secondly, I think that also suggests that perhaps this $150 billion, upward revision in Capex is not enough for this year. We may see actually further revisions throughout the year, and that's part of the fundraising that we're seeing from these hyperscalers. Because remember, if you look at 2025, we started off the beginning of the year with higher than expected Capex, and it kept getting raised throughout the year. And so we're starting off this year in a similar spot where, again, these numbers have beat the market expectations for this year's Capex, but it could continue to go higher throughout the year.
Frank, why is it so important for the likes of Nvidia to have strong investments in the likes of OpenAI? And I ask this at a time when there is a lot of concern about circular financing and how much there needs to be essentially vendor financing, right? The likes of Nvidia giving a company money to then buy its chips. What's the rationale behind this?
Well, I think Nvidia's dependency on the original hyperscalers driving their their overall revenues, it's that narrative isn't quite as the same as it was 2 years ago, because we've seen these hyperscalers looking to develop their own chips, right? The ASIC chip that's driving Broadcom with Google and TPU. So NVIDIA needs to really increase their TAM opportunities outside of the core CSPs, and that's enterprise, that's sovereign, and empowering that is our companies like OpenAI. I mean, Stargate is basically a sovereign project. So I think that's why it's more important that NVIDIA needs to find a way to expand its original market beyond the hyperscalers.
Frank, just pulling you away a little bit from hardware, forgive me, but I do think that it's associated with the conversation you're ultimately having. Isn't Gemini and Alphabet and the money they're throwing at this market right now to win just crushing the OpenAI story?
I think it's a bit of back and forth over the last couple of months. I think the narrative has shifted in favor of Google, not only because of Gemini, but Google has done a lot on a hardware side, both on the chips as well as the networking. That's closed the gap. But at the same time, we do expect there will be another upgrade model for OpenAI coming out in the next few months. And so we'll see whether that momentum can start swinging the other way. So I think it's still a little too early to say definitively who's going to be the long-term winner. I think at the moment, everyone's expanding and still very much in the game.
Frank, forgive me for going back to an earlier question, but I do want to get your ideas on what this might mean for semis. This OpenAI IPO, how much of a market event that will be for the whole ecosystem?
Well, I think it's very important because OpenAI sort of kicked off that whole narrative of this much bigger TAM with a number of gigawatts and how that's going to drive, much more revenue. We've done some work looking at if the 18 gigawatt expansion for OpenAI materializes as expected, that could potentially double NVIDIA's data center revenue by almost 100% from where we are this year. I mean, they're going to probably approach 350 billion in revenue just on data centers. The magnitude and scale of these gigawatt announcements could almost double the revenue from where we are this year.
Interesting. Frank, thank you, sir. Thanks for being open and honest with us. Frank Lee there of HSBC on NVIDIA and the whole ecosystem. If you're just joining us, a few headlines I want to get through this morning. So this was from Alphabet a little bit earlier. So they're going to raise about $15 billion from a 7-part US debt sale. This follows Oracle in the past few weeks or so. They issued about $25 billion, and that was taken down pretty well. Bear in mind that Alphabet has a super strong balance sheet relative to, say, an Oracle. So I'm not anticipating massive concerns there, but we'll track the numbers anyway. This came from the NEC director moments ago. And this, I think, is material from Kevin Hassett. We should expect slightly lower jobs numbers, and lower jobs numbers shouldn't trigger panic. What's that headline about going into payrolls on Wednesday?
It seems like we're not going to get a good number, and two-year yields are rolling over as a result of this. They're lower, not by a significant amount, just by about 2 basis points, but it highlights people are taking this as forward guidance on what we should expect on Wednesday's non-farm payrolls.
Coming up on the program, we'll catch up with Lou Tilley of Wilmington Trust, previewing a big week of economic data. Stocks are down by about 0.1% on the S&P. On the Nasdaq, we're down by 0.2%. In the bond market, curious story emerging in the last hour or so. Yields were up at the long end of the curve. 10-year bond yields higher by about 3 or 4 basis points at one point. A couple of reasons for that. A story out of China that Chinese banks were urged to curb exposure to US treasuries, the massive performance out of Japan, the fact that Japanese bond yields on a 10-year maturity rose just a little bit. And then we also had a 7-part dollar bond sale from Alphabet. $15 billion debt sale coming from Alphabet a little bit later this morning. All reasons for high yields. And then this happened moments ago. Kevin Hassett, the NEC director, with a strong steer going into Wednesday's payrolls report, saying that we should expect slightly lower jobs numbers, and those lower jobs numbers shouldn't trigger panic. Those headlines crossing just moments ago. And for all the reasons for high yields this morning, yields reverse course. Lower, particularly at the front end of the curve. We're down by about a basis point or two to 348.
So you say giving a steer, and that is certainly how the market is treating it. It would be highly unusual for someone who got a forward look on the data that doesn't come out until Wednesday at 8:30 a.m. Eastern to deliver that in sort of a wink, wink, nod, nod. So it raises this question, what exactly is he talking about in terms of what he's expecting? Is it based on his own analysis? And then furthermore, how much is this going to drive some skepticism in equities as we're seeing right now? Because ultimately it speaks to the real economy that needs to keep chugging along in order for the overall index to remain at a higher level.
Well, I can't speak to exactly what Kevin Hassett is seeing. Is this his own analysis, or did he actually see the jobs report? What I do know is that the White House does get the jobs report ahead of the release. It's a little bit awkward now because we're supposed to have it on Friday. It was Wednesday. He could have gotten it last night or seen it this morning, and then that is potentially where some of these remarks and what he's thinking about in terms of the labor market are coming from.
So the estimates, as you know, going into Wednesday, super wide, 135 at the high end, -10 at the low end. The median is 69. I think a lot of people also on Wall Street would say you can get a low number, but I wouldn't panic because ultimately the break-even rate is so low right now. If that's the point the NEC director is trying to make, I don't know, going into Wednesday, but the headline's certainly unhelpful. If you're trying to put together an estimate based on the data we've seen so far, I think you've got to sort of revise it down lower just a little bit after those comments.
It's a great point. The market hasn't been freaking out even when we've gotten a lower number because there is this nuance. So again, a curious comment that I'm sure will be dissected. We'll see a lot of notes, I'm sure, with very clever headlines that come out in the next couple of days, and I'm looking forward to them. Please send them my way.
The South Side will do their bit, no doubt. 1 hour away from the open and bell. Equity futures on the S&P down by 1/10% with your morning movers. Danny has more. Hey, Danny.
Hey, John. Tech might be underperforming this morning, but here is one bright spot for it. ST Micro, reached an agreement with Amazon. They'll be supplying the semiconductors for Amazon Web Services for their cloud providing, and we know Amazon has a lot of Capex to burn. STM had been seen behind on the race for AI infrastructure, so this kind of gives them a little bit of a boost forward. Amazon also gets to buy warrants, which allow them STM stock over the next 7 years. Elsewhere, some pharma news, starting with the drama that has been Hims and Hers. First, they unleash a pill, a Wegovy copy pill, for less than $50. Novo Nordisk sues them. The FDA says stop making that, and over the weekend they say we are going to stop making that. So shares down 21.6%. Novo up 4.8%. Finally, some other pharma news. This one, a deal, Eli Lilly agreeing to buy Orna Pharmaceuticals, a multi-billion-dollar deal that will give it access to autoimmune disease treatments. And it just shows that Lilly is trying to widen its portfolio beyond just obesity medication. Those shares up more than 2%, John.
Danny, did Matthew Miller make it into work this morning?
He did. Why were you worried? Did something go wrong?
Super Bowl weekend, you never know.
I see. Well, he is going to be speaking with Lawrence Stroll of F1, so that sport reigning supreme for him. So he made sure to get in.
Now we know why Matt's here. All right, Danny, thank you. You never know with Miller, do you?
He definitely seems like a guy who's having a Super Bowl rager at his house.
No doubt about it. Matt Miller, Danny Berger coming up in about 30 minutes' time. Let's turn to the economy. A key week of data on deck, headlined by payrolls and CPI data. Enda Curran joined us now for more. Enda, I've got to ask you, did Kevin Hassett just drop a hint, a big hint, going into Wednesday?
Look, it's very unusual comments coming so close to the official release of jobs data, John, as you were mentioning earlier in your show. And the other part, of course, is the fact that before the last jobs release, the president on his social media account did release a partial pre-release of some of that jobs number. So obviously these kind of comments will stoke questions around, was this a signal of what's coming down the pipes or not? We just don't know until he clarifies it. But either way, the monthly jobs data are supposed to hold up okay. They're meant to come in around 69,000 according to the Economist survey. Unemployment holding around 4.4%. That's meant to have leaned into the idea of a stabilising jobs market. But maybe, and this is perhaps what Mr. Hassett's speaking to, we do also get the annual revisions on Wednesday, and they're expected to show fairly hefty downward revisions for the previous year, the year to March 2025. Maybe 650,000 less jobs created, according to Bloomberg Economics. Now, if that happens, then we get a headline that the jobs market really was much weaker than people thought it was. But again, we don't know. We'll have to hear more clarity from the White House in terms of what they're speaking about. But certainly this will stoke speculation about whether it was or was not a signal.
So, Enda, it just raised the question, what is and what isn't good right now in the jobs market? Is 20K okay? Is 10 okay? Is zero break even? I've got no idea. Enda, this is what Governor Waller thinks. And his opinion on the matter is far more important than mine because he sets policy at the monetary policy level with the Federal Reserve. He said this in a recent statement. Last year's data will be revised downwards soon to likely show that there will virtually be no growth in payroll employment in 2025, zero zip nada. And he went on to say that all of this suggests that a substantial deterioration in the labour market is a significant risk. And what is good? What is bad? And where is break even right now in this economy?
Well, break-even is certainly a very academic exercise right now, John. As you know, very different estimates because of the impact of the immigration crackdown and the like. So hard to get a precise number on that. But Governor Waller, of course, yes, he was in the race to be the Fed chair. That's probably part of the story here. But Governor Waller, of course, has been very strong in the labour market. He's made early calls ahead of others on the FOMC policy committee about where things were going. He was early in calling for cuts last year, for example. So, you know, when he speaks in the labour market, he will be listened to. But we know the backstory is that for all the mood music and for all the narrative, that we still don't see much evidence of broad-based mass layoffs. So there's an argument out there that we're still in this low-hire, low-fire environment. The Fed last month talking about signs of stabilisation in the jobs market. That was a little bit of a change of tune from them. And as I mentioned earlier, the jobs data on Wednesday is meant to show that things are holding up okay. Now, of course, if we see a much weaker jobs number on Wednesday, that might again reignite the idea that, hold on a second, we're now starting to see catch-up, labour market being a lag, maybe it is softer than people thought. So we really need to see what these numbers on Wednesday tell us to give us an update on where things are at.
And thanks for the coverage down in Washington. Enda Curran there of Bloomberg. Let's stay on the data. Luke Tilley of Wilmington Trust writing the US labour market is in an extremely weakened condition. We are officially projecting a 60,000 gain in private payrolls and the unemployment rate to tick up to 4.5%. Luke joins us now for more. Luke, welcome back. I feel like I've been asking this question for the best part of 12 months now. What is a good number on Wednesday? What does that look like these days?
Well, it's obviously a lot lower because of the low labor force growth that we have. But I don't spend a lot of time thinking about what a, quote, break-even number is. Because you could construct a mathematical example where you had negative job growth and negative labor force. The unemployment rate could mathematically hold stable, but you would get much weaker spending and you would get much weaker economic performance. So I really think that break-even concept is just sort of an academic one, like Enda just said. We're expecting pretty low growth, and what we've really been noticing and focused on is the fact that the private sector has shed almost 150,000 jobs when you remove the healthcare sector. And the healthcare sector is important, but it's also not sensitive to the cycle at all. It was adding jobs through the global financial crisis. So we've seen that job loss, and that really points to a lot of reticence and a lot of reluctance for private firms and the private sectors to be hiring. And that's gonna weigh on growth, we think.
This is important, Luke. You're emphasizing the demand side of the employment picture, the fact that a lot of employers are really holding off on their hiring plans. Kevin Hassett, the economic advisor to President Trump, in his comments was talking about how we should expect a lower jobs number. He was referring to productivity. He was referring to less immigration. He was saying that was the reason that we should maybe expect just a little bit less of a robust number. Do you think that that's a huge part of the picture?
Yeah, I haven't seen his full statement yet. Obviously, as Enda said, it's a little bit unusual for somebody to front run the report like that, if in fact that's what he's done. I am a little surprised that he introduced the word panic on his own to talk about the jobs report. So perhaps that weighs on the expectations a little bit. We see this as mostly a demand side phenomenon. Yes, there's going to be slower job growth because of low immigration. Yes, we are losing some labor demand because of the impacts of artificial intelligence. But if you look through all of the company commentary, whether it's the ISM manufacturing number, which was very strong, but look through the comments, a lot of discussion of weak demand and just sort of holding the line on hiring, not replacing people. The Richmond Fed's survey of CFOs, large and small companies, the National Federation of Independent Business, all pointing to trade tariffs, uncertainty about overall demand as the driver and their concern. So we mostly see it as a demand side phenomenon, even though there are definitely supply factors at work too.
I just want to veer a little bit to the far askance. I don't want to say left or right because it might be viewed as political, but I'm just curious going forward how you view some of these types of statements that could be forward tells or that couldn't be forward tells, or statements about investments in certain areas, or some of these strategic reserves that we could get, say, in metals. I mean, how do you view some of the political discourse when making certain investments? Do you take this as sort of gospel? Do you ignore the noise?
Well, in our investment committee, we really focus on a 9 or 12-month horizon going forward. So we're looking at where the economy is going to go. And we are pretty optimistic about long-term growth in the U.S. when you get out to 12 months and 24 months. What we're trying to figure out right now is how big this short-term impact is, because companies are adjusting to the significant hike in tariffs and also trying to digest and make those decisions about long-term Capex plans. Yes, we do think that there is going to be reshoring of manufacturing activity, not so much jobs, but manufacturing activity, but that does take a long time. So the real question here is, are we going to have larger short-term pain in terms of these companies not hiring as much before you get that long-term gain? And we think that it is a little bit on the risky side. We expect the unemployment rate to rise to 4.8% by the middle of the year. So that's going to be challenging as we look forward. But this is fundamentally an adjustment. It's not a bearish view or that we think that there's something fundamentally wrong with the economy. We're in a rapid adjustment period, and companies have to make some pretty tough decisions. So long-term positive, but short-term, there could be some weakness.
Luke, as you know, Wednesday's release is important because we'll get the annual revisions to the job count. What are you expecting on that front for 2025 revisions?
Yeah, we had the preliminary look at that last year with something like 900,000. This will be a more solid count of the revisions. This and we don't have our own official number, but it is really clear to us that the Bureau of Labor Statistics is having a very hard time pegging the birth-death model and trying to figure out how many firms were created, how many firms went away. We know that Chair Powell has said that the FOMC is operating on the assumption that the BLS is overstating job growth by as much as 60,000 jobs per month. So we'll get a little bit more information about that on Wednesday, of course, as you said. And it just points to the fact that we need to be very careful about every single jobs release that comes out. We have to look and see if there are downward revisions for November and December, for example. So it just makes it a little bit more challenging to read into each jobs report, and we will get that update, but we're a little bit more focused on the look ahead.
Hey, Luke, it's good to see you. Thanks for sharing your thoughts. Luke Tilley there of Wilmington Trust on the labour market and the general US economy. Getting the fuller transcript now from the NEC director, Kevin Hassett, engaging with the American press a little bit earlier on this morning, saying the break-even job number is quite a bit lower than it was under Biden when there were people, basically coming across the border willy-nilly. Direct quote, not mine. And so I think that you should expect slightly smaller job numbers that are consistent with high GDP growth right now, and that one shouldn't panic if you see a sequence of numbers that are lower than you're used to, because again, population growth is going down and productivity growth is rocketing. It's an unusual set of circumstances.
So that is the context, which I think is really important to his fuller comments, which is this has to do with immigration coming down. That lowers the overall number of population growth. And two, it's productivity. And the productivity boom is going to continue to power the economy. And this also is going to have a negative effect necessarily on the overall jobs growth in the near term. So that is what he is talking about. It is being interpreted by markets as being a tell on what we might get on Wednesday. It could easily be inferred also, though, as really describing his overall picture. Nonetheless, it does come at a sort of interesting moment in the week.
If you're wondering what the follow-up question was to that particular statement, it was on the government shutdown, and there wasn't really a follow-up question. So that's disappointing. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Just recapping those comments by NEC Director Kevin Hassett. He warned we could see slightly lower than expected jobs numbers this week, and that the weaker data should not trigger a panic. Hassett citing a slower pace of population growth. As for the market reaction, you are seeing two-year yields moving slightly lower. U.S. payrolls were delayed last week due to the brief partial government shutdown and are set to be released on Wednesday. Meanwhile, Treasury Secretary Scott Bessent suggesting the Senate should start hearings on Kevin Warsh's Fed chair nomination. This despite GOP pushback to block the nomination until the criminal investigation against current Fed Chair Jay Powell is resolved. Bessent's pushing to get the hearings underway and, quote, see where the investigation goes. And we're seeing Alphabet shares edging lower after the tech giant announced a $7-part bond sale. It's the latest in what's been a borrowing spree by companies at the forefront of the AI investment boom. Sources telling us here at Bloomberg, Alphabet is also offering debt in pound sterling and Swiss franc denominated bonds. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Plus, we'll catch up with Osun Kwan of Wells Fargo, remaining cautious on the hyperscalers. That conversation up next.
were in a period where that earnings recovery kept getting pushed out. If we continue to get data like the ISM we just got, that helps cement investors' confidence in this earnings recovery and more cyclical recovery. And the fact that corporate guidance has actually been pretty supportive, I think gives us and can give investors a little bit more confidence this time around.
That was Jill Carey-Hall of Bank of America a little bit earlier on this morning. If you're just joining us, good morning. Counting it down to the opening bell, about 41 minutes away. Equity futures negative by, let's call it 0.2%, down by 0.26 on the Nasdaq 100. As we count you down, your trading diary set up as follows. Big calendar full of data. Today, you'll also get some Fed speak. Waller, Bostic, Myron in focus. Tomorrow, retail sales plus earnings from Coca-Cola and Ford. Wednesday, the main event on the data side, payrolls Wednesday. Thursday, another round of claims. And on Friday, CPI data. Let's turn back to the markets. Osun Kwan of Wells Fargo writing, we continue to expect the Capex cycle to be much bigger and much longer than expected. We remain cautious on the hyperscalers. Osun joins us now for more. Osun, good to see you. It's been a mixed earnings season for the hyperscalers. Some stocks getting rewarded, others being punished. I'm thinking of Microsoft down by 10%. You expecting to see more of the same in the year ahead?
Yeah, I mean, that's been the case for the past 3 quarters or so. For the hyperscalers, it's really a stock pickers group, right? It's about who's going to win this race and who's going to lose this race. As a macro person, that's not a very attractive group to us. We very much own the semis and the AI infrastructure side of things.
Where the money's going.
Yeah, exactly. I mean, the market hates companies that are in an investment cycle, which are basically hyperscalers. Their return on incremental invested capital, that's actually similar to the rest of the index. They're a lot more asset heavy than the rest of the index now. And I think the Capex cycle is likely to continue for a very long time.
So cautious on the hyperscalers. Quote, very long time, lots of spending, go to where the beneficiaries are, the chip players. Now we have to talk about what got hammered last week. Where's software fit in with all of that?
Yeah, I mean, software is interesting. So for what it's worth, our newly launched systematic sector strategy is ranking software as number 1. And that's a very short-term trading model, but sentiment is atrocious. It's at an all-time low. Fundamentals are actually pretty good. So in Q4, software companies posted 25% EPS growth year over year, which was the strongest growth rate in 2.5 years. They beat consensus by 5%. So it wasn't anything to do with earnings. It wasn't anything to do with fundamentals today. It's really sentiment overhang that they are going to get disrupted. And the market basically decided that everyone's going to get disrupted by AI. There are going to be some winners. There are going to be infrastructure software companies, consumption model software companies that are actually going to benefit from this. So the market just shot first and is going to ask questions later. And I think this is time to do some analysis, deep dive analysis on which stocks are actually going to do better and not be disrupted.
There's a broader question about whether you could see this rotation away from some of the hyperscalers, putting software aside, and whether you can see the overall index continue to grind higher. And we have seen that in part because of this expectation of growth. Do you see this as something that is sustainable? Or do you think that this is like 2000, the way that Jim Reed of Deutsche Bank laid out, where you're going to see 6 months of equalization and then a huge downdraft where everyone gets caught up in the same?
Yeah, I don't think we're there yet. I don't think it's a bubble. I mean, NASDAQ's entire outperformance since the end of tech bubble has been driven by better fundamentals than the S&P 500. I think what we're starting to see is more of a rotation out of those tech and everything tech is going to be winners of AI to now you gotta be more selective. Also, I think we're in a reflation cycle, meaning all these cyclical companies are going to start to benefit from the PMI upcycle that we think we're in. We're in a restocking cycle. So back in January, we saw the sharpest rebuild in inventories in 3 years. So after 3 years of destocking, I think we're finally in a restocking cycle. And I think the best way to play that is through commodities. I think that's why energy stocks are higher, material stocks are higher. For different reasons, I still like gold as well. So I think commodity prices are going to continue to grind higher. And, to do that, to play that, I think you own cyclicals and small caps.
Well, it's just, I keep going back to this question of what kind of cycle are we in when we get to 7,800 at the end of this year, which is your forecast for the S&P 500. Can we do it without the big drivers of this that account for market capitalizations equal to the spending of a variety of different governments in 1 year? I mean, it just raises a question how we get there, especially if all this stuff costs money and people don't like it when it costs money and they got to pay for it.
Yeah, I mean, I think semis are going to do well. We still like semis. I mean, this, like I said, I think the AI Capex cycle is going to be much bigger than and much longer than what a lot of people expect.
You've said that a few times now. How much bigger, how much longer? What kind of numbers are you thinking about? 650 is a big number to me. How much bigger, how much longer?
I mean, every quarter since 2024, there was a step-up increase in AI Capex consensus numbers. And we saw the same thing this quarter, too. I think we see that as long as these companies are in this AI arms race, which I think are in, they continue to raise debt. I mean, we saw the Alphabet bond issuance today, too. In Q4 alone, the Big Four issued $150 billion of bonds. So, and they're going to spend it. And I think we are still in like the middle innings of the AI Capex cycle, and I think we are moving much higher.
But to your point, we're already at the point where there are some market constraints, a bit of pushback. Mm-hmm. Now, what kind of numbers are you thinking about where we get to the point where actually the pushback is so vicious they have to stop? How much further can they go is what we're asking.
The market was pushing back in 2024 as well. This isn't the first time that the market started pushing back. Yet companies still are investing in CapEx. So this is really an arms race. And the biggest reason why they're investing is it's more because they don't want to be disrupted than to make money, at least for now. And as long as they have that disruption risk, it's an existential risk that they're seeing. So they kind of have to invest.
Osun, good to see you. Lots to think about. Osun Kwon there of Wells Fargo. Going back to that quote a few summers ago from the Alphabet CEO that it was a much bigger risk to underinvest than overinvest, and that we're seeing evidence of that with the latest numbers.
Yeah, and Osun was talking about how much the numbers have exponentially increased year over year, 80, 90, 100% year over year increase. What's the limit to that? Ultimately, we will get tested time and time again, Alphabet, with their $15 billion offering later today.
650 isn't big enough, apparently, and that's a pretty big number. I'll be interested to see how big that number is at the end of the year. Bigger, according to Osun, maybe a lot bigger. Coming up tomorrow, Francis Donald of RBC, Eric Johnson of Cantor Fitzgerald, Mike Pyle of BlackRock, Michael Kantrowitz of Piper Sandler from New York City. Have a wonderful week. Looking forward to covering it with you. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.